Okay, this is panel 2, developing the 21st century surveillance program. Now we've asked George Harada, the Associate Director of our Office of Data and Technology, who works with John, the Chief of our Office of Data and Technology, to put together a first-of-a-kind analysis of the Commission's data. I've never seen a document that looks like this, and we just kind of intended to pull together everything we're looking at and decide it kind of appropriately, and to really focus on some of the resources that are used to support this. And we'll look at some of our enforcement data, look at some of our new market data. And this is, I think, just an opportunity to provide everybody some perspective on kind of what we're dealing with and really the opportunities that we have with the data. And I want people who have dealt with this type of data before, and that these are certainly the exchange leaders that have these responsibilities. We've got Tribune and others to contribute to this. So George is going to set us off, kind of showing what's possible or kind of what we have today, and then obviously I want to think about what is optimal. This is not to defend the current practice. This is not to be constrained by the current practice. This is really intended to be an opportunity with a fresh sheet of paper, design that 21st century surveillance system and think about the key tools that the Commission should have in place. And I was encouraged by the first panel that said, you know, it's interesting what we're talking about today, but let's talk about the next panel and how we're really going to enforce it. A couple of points were made that you're going to have technology in the markets. It's not something, a genie you can't put back in the bottle. And so we're going to need to deal with it. And in dealing with it, how do we establish that surveillance program? So let me turn it over to George. He'll be followed by Andrew Vrabel with CME. And then we'll go to Steve Joachim over here with FINRA to have FINRA help us think about some of the innovative ideas that they have cooking in the equities markets, because clearly we can't stop talking about equities today. And anybody at the SEC, don't tell the chairman, will you? It was all about futures today. We'll be followed by Steve Creamer, obviously to provide his input as with the PTG and proprietary traders about what they think would be an optimal 21st century. And then Dave Lauer will contribute his ideas as a former trader and his thoughts, and we'll wrap it up with Tribune Bland with ICE to provide some closing comments. So we'll bookend the exchanges and add some other color in between. So George, it's all yours.
All right, thank you, Commissioner Amalia. So this is the part about data, and I have to tell you, I'm a little anxious about this presentation. The challenge is we've just all had lunch, you know, everybody's kind of settling in, and I don't know if there's anything less interesting than data, but we're going to try our best to make it at least somewhat interesting. So
we could spend the entire day talking about equity market structure.
There you go. My hope is that at least most of you will stay awake during this. That I will consider it a victory if that's where we end up. So ultimately, what I want to do is talk about the data at CFTC. We'll talk a little bit about the daily data volumes. I am nervous about that particular slide. Spent a lot of time putting together a slide on volumes, because ordinarily I would do this presentation internally and no one would check my numbers all that closely, but since I'm right next to Tribune, he'll probably kick me and go, well, "What? That number doesn't sound right. We send you way more than that on a daily basis."
Let's call it equal, so you don't kick me on my part of the presentation, and I won't kick you on your part.
Perfect. All right, we got a truce going on here, but no, actually, we shouldn't do that. We'll get ourselves in trouble for some collusion. Anyways, the idea here is we'll talk about daily data volumes. Hopefully, we're close. 9 categories of data. So what we try to do is take the data that we have and say, could we categorize it? And there are many ways you could categorize the data, but we came up with these 9 categories of data. Then we'll talk about some details of the data categories as we break down those 9 categories into further detail, some information about the data loading challenges that we have, some trends in data volume, and then ultimately we'll finish up with one slide on SDR data harmonization just to get you up to date with what's happening there. So, okay, so this is my This is my big slide. This is really difficult because what I wanted to do was try to find a way to show all the data that we have at CFTC in one diagram. And that's not particularly easy to do. And then I put the ambitious thing that I was going to try to come up with a scaling mechanism, 2.5 million records per inch. And then we ran into a little problem, right? Time and sales threw it off, right? 240 million records are coming in. It's sort of the top of the order book. Every time a record, there's a change at the top of the order book, we have the best bid, the best ask. So there's 2 records there. And so it's not to full scale because the time and sales data it would be 8 feet across. Now, I was thinking that it would be kind of, to try to keep you guys awake after lunch, it would be interesting if we rolled in an 8-foot long wide ball right there. That's true. It probably is to scale on that screen. There you go. Right. So if we had an 8-foot size ball, that would be to scale because at 2.5 million records per inch. So that's one piece of the data that we have. Another big one, and by the way, I will confess, anybody that I've shown this to internally has said, well, you're comparing apples to oranges. And I will say the enforcement data is a little apples to oranges because everything is in approximate number of millions of records per day that we are loading at CFTC. But the enforcement data doesn't really come in as records. It's a unstructured data. It's audio tapes. It's email records. It's a whole bunch of different things that get subpoenaed. There is some structured data in there. So I chose to use a 0.2 to 1 terabytes of data a week that we're ingesting. And again, that would be about 10 feet. And the reason I did that is I said, well, what you'll see later is the amount of enforcement data we have on disk is roughly equal to the amount of data we have in the structured data side. So they're about equal. So I made that one a 10-foot wide ball compared to all the other things combined together. It's about similar. So we have futures and swaps position data, roughly about 2 million futures coming in a day, about 14 million on the swaps. But remember, and we'll get to it shortly, is that we're not ingesting all the swaps data. We're only ingesting a subset. So this is the swaps data that we pull in. We have Steve Reich here from FERC. So, Steve, this is for you. We have the FERC data. We're sending data to FERC. This is part of our MOU that was signed in January, and we're sending over about a third of a million records a day. And so it's position data, market data, that sort of thing that helps them with the natural gas and particularly the electricity markets to use that data to allow FERC to have a better view of the entire market as a whole. So we have that information there. And then on this other end here, another big piece of data is our futures intraday trade data. So again, that's the CME, ICE, and the other exchanges. It's all your intraday trades, and that comes out to about 10 million records a day. And we've talked about, and I think Commissioner Malia will get there, where we're going to discuss the idea if we were to ingest the message data, right? If we pull that message data in, what would that be like? And we've done some approximations. We've made some calls. We've looked around. We've looked at sample data, and we're looking at that at being 200, 300, 400 million records a day. Of course, obviously, that would take that bubble and blow it up pretty significantly. So that is, again, that was our position data. That's our intraday trade data. We've got our enforcement stuff. Now we'll get into some more of the details. Market data, again, it seems small, but it is there. It's a 0.2 million records a day of market data. We have a lot of stuff. These 3 bubbles here, margin and collateral, valuation stress test, and financial statement capitalization, these are all part of our risk surveillance program. And that program has really grown significantly over the last 2 years. And so we're getting more and more sophisticated ways to measure and do risk surveillance of the market. So that's all that information coming in toward there. And then finally, we have organization product data. That's your Form 40s, your Form 102s, any information we have on organizations, LEI information, that sort of thing. And then, of course, this is completely not to scale for our SDRs here. I know we have Marisol here and others, so we have I've made this more like a cloud because basically it's a reference to this data that's offsite that we're tapping into now and looking at for the swaps data repository. So, all right, so that's that slide. We'll go into a little bit more detail. Again, this is just the 9 categories. I won't go through them, but it's the same that we saw before: intraday trades, time and sales, position data, market data, margin and collateral, valuation, stress tests, financial statements, capitalization, org and product data, and enforcement data. So the idea here, I put the slide in here. Again, you all have the handouts, and this is, I believe, going to be available electronically, and it'll give you some details as to what we were including in those 9 categories. And again, I would say that three of those categories are very risk-oriented, the margin and collateral data, valuation, stress test, and financial statement capitalization. So a natural question would always be, all right, so we've got this data, but how does, what fits in those categories? And again, I won't go, bore you with all the details, but I wanted to put this slide in here so that you could see, and this is color-coded back to my bubble diagram, so it's using the same colors there is here, and so you can start to see all the different pieces that come in, for example, between the swaps and the future side. So for example, when you look at the event data, we're pulling in some event data, Part 45 data from DDR at this point, but that's DDR sending us an FTP of that data, and so that data we are ingesting. These little funny arrows here indicate that we're streaming data. We're going out to get that data from, say, SDR portals, or getting data from market, or from ICE Clear Credit Margin API, NFA, daily seg funds, that sort of thing. So there are references to data that we're not necessarily storing at CFTC, but we're referencing that data outside. And then this funny little symbol here is toward the idea of data that we export out. So FERC is the only place that we export data out on a regular basis, and we're sending out that FERC large trader and market export data. But otherwise, this just shows you where we're getting the data, and it shows you, the various sources for that information, whether it be Reuters, Future Source, Bloomberg, market, or large trader data, different Part 17, Part 16, Part 20, all that sort of thing. So anyways, that's a slide for you to look at a future date, but it gives you an idea of where we're getting our basis of information. So we tried to. This is my attempt at trying to draw out some disks. In the old days, it's floppy disks. There's no good image of a hard drive. So, anyways, this is my attempt at trying to lay out where we're using our storage. And what we find here is that we break our storage and our servers into four main categories: enterprise infrastructure stuff. So all of you have firms. You have servers and data storage for your email and for your voicemail and for your intrusion detection software and all that kind of thing. So you've got lots of that sort of thing. Ultimately, though, when it comes to storage, the vast majority of what we store is for the e-law program and for our structured market data. So again, this is the production side of our data, and we're looking at, this is in terabytes. It's not huge, but it's significant enough that there is some serious crunching going on, 160 terabytes roughly. About 39% of all the data stored is enforcement related, 38% is structured. And that structured stuff is very compact. So you've got to understand that is a ton of records. If you're going to match the amount of storage that e-law, because if you think about what a voice record is, a voice record, takes up a huge amount of space, or any sort of data like that, video, voice. And so when your structured data matches that's representing a heck of a lot of structured data that we have on disk. But we move on to the idea of servers. So this is my stack of servers here. And this number seems a little low, but I'll talk you through it a little bit. So in fact, I'm going to refer to one of my notes here so I can speak to it more clearly. So what we have here is the servers by these different four categories. Now, if you think about your own enterprise, you do need lots of servers that are very specific, right? An intrusion detection system, a BlackBerry server, a voicemail server, an email server, and all that kind of thing. So each one of those, it's not surprising that we have 120, 130 of those servers. This, by the way, is production servers. It's very important to know the distinction, because when I looked at these numbers, I thought, well, they seem low. People here running major exchanges will say, well, that's all very small number of servers. But this is our production servers that we're running. So you could triple this because you put in your test and development servers, and you get those numbers. But e-law tends to have more, and then we have our structured data. So the structured data, by the way, are things for our data ingestion applications, our SaaS servers, our large trader servers, our trade servers, all those kind of buckets of data we were looking at of that type. Enterprise applications are more your generic servers, like timesheets and basic things like that. Your enterprise management of documents, all of Commissioner Amalia's speeches. I think that represents, going back to the slide, I should have showed that taking a third of the available disk storage space, but there you go. There is a clear legacy that Commissioner Amalia is going to leave us here. And, so there we go. Now, that is the servers. But so I wanted to answer the question, when you look at this and you see e-law and you go, well, why so many servers? This is our little diagram of servers. And we've sort of sized these based on maybe their significance. But there's things here. We originally had this laid out where it showed the brand, the actual software we use, but then we thought, let's just make it more generic. So the types of software we're using here: FOIA tracking, e-discovery, digital forensics, legacy e-discovery, e-discovery review, audio search, trial presentation, and so on. So it's a very full-blown set of applications. The key thing to keep in mind, though, when we're talking about data loading, which is the next couple slides, is to understand that this is a highly standardized data business functions and software products. So this is an assembly line that's been set up, and if you think about it, it's pretty. Again, no offense to the e-law people that are here, but it is a standardized approach that we go through from an IT perspective. Obviously, from a lawyer's perspective, every one of those cases is going to be quite different. But from an IT perspective, we have these applications. The assembly line is set up. When we go and do a subpoena and we ask for more information, it goes into the machine. The machine is set up to take that sort of data. But this explains why so many servers is because we have so many applications on the e-law or the enforcement side. So here's a little bit about our e-law staffing and data trends, and then we're going to talk about our structured data trends. So this shows you at the bottom the number of FTEs and then the number of contractors. It's been fairly steady over the last couple of years from 2009 through 2013. But what you see is the amount of gigabytes processed per month continues to grow. So as time goes, we're continuing to keep pace. It doesn't mean that we don't need more resources. I want to be clear that this is not we're happy with our resources or anything like that. If somebody asks me the question, does CFTC need further resources, I will give a resounding yes. We certainly could use more resources. But this shows, again, the ramping up of our staffing relatively flat, but the amount of data we're ingesting continues to grow significantly. So on the other side of it, and I'll try to run through this one a little slower because there's a punch point here, is this is the status of our structured data loading at CFTC. So what we have is a continually increasing scope and complexity of the structured data files. So this is the non-e-law stuff. In 2013, we added 65 new types of data. Prior to 2013, we only handled 51 in total. So what has happened is that since 2010 to 2014, we've had a huge jump from 20-some to over 120 some different types of loaders. And we were trying to, when John Rogers and I were talking about this, we were trying to come up with a metaphor. It's not a perfect metaphor, but it hopefully will help you guys to understand. And I'm sure you feel the same way. Any of you that are subject to our regulations that try to produce this data is also as challenging as it is for us to ingest it. Obviously, there's lots of stuff so each new data set requires data standardization, data architecture, custom loaders, data quality checks, monitoring feedback. It's all sorts of working with with you guys to come up with those standards. We try to adopt standards like FixML and FPML, but unlike e-law, each new data set is a major project unto itself. It's analogous to standing up a new factory production line. So we have the e-law factory production line operational, but now we need to put in this other type of production line every time we part 45 or part 39. Anytime we put new parts online, we have to do a major ramp up to do that. And data standardization, harmonization is critical. Again, I know that I almost feel like I'm preaching to the choir on this one because I know that you guys on your end have to, Marisol's giving me that knowing look. Yes, exactly. That challenge also is you have to meet that standard as well. So we're there to receive it, but you have to produce it. And we recognize that there are some challenges to meeting it. But again, here's a case where we've really been resource constrained. The number of resources on this end has been dropping. Ed Wayner, who's sitting in the back there, who's doing a great job of managing this particular group. But with the limited resources, and this is one of those it takes a village sort of thing, because it's not just the data ingest team, but it's throughout the entire commission has to get involved whenever we stand up a new data standard. So that is one of the challenges that we face. But I think, again, Ed's doing a great job of rising to that challenge. So this is kind of Ed's world here, right? I should have labeled this Ed's world instead of challenges and but Ed is running a 24-hour shop here, and this shows the times that the data comes in and the processing. And right here in the middle is 8 to 5 when the CFTC analysts are looking at the data. But the data is coming in all throughout the day, and certain things take hours to load, some things take minutes to load, whatever it is. But this is his day, monitoring all this stuff, making sure it all works. And so this is just part of the setup in the day. It's a challenge to keep it all running, but again, Ed's doing a great job doing that. So, anyways, that is the last slide on data and what we're doing with that, just to give you a flavor of the type of data we have and all the pieces. And then, did you want to ask a question?
Yeah,
please.
I was going to ask a quick
Sure.
question. I mean, because this informs the rest of what we're going to be talking about, but. How do you? I mean, when you bring in the data, I mean, does market surveillance have access to all of these bubbles in the first slide? I mean, is there anyone who looks across all of these pools of data?
Right. So does market surveillance have access to all this data? Yes. I mean, it's market surveillance or risk surveillance. Each one, of course, has their own focus area, but the data is available. Now, I think what Commissioner Malia will sort of get to is how are we integrating this? How are we looking across all that data? That's really, the $64,000 question. But yes, absolutely, this data, all this data that we're loading, none of the data we're loading for our own, just for fun, but no, any data we get, we're loading, and it's all becoming available. But I think that the challenge we always have is the integration of that data, particularly, and I think the LEI is a huge step toward that, because now with the LEI we can try to see positions across all these different asset classes, but we still have a while to go. We have the OCR rule that's helping toward that, but the challenge is taking these these data sets and trying to merge them together in a meaningful way. Yeah. So, all right. Well, let me hit the last slide, and then we'll let the other panelists have their chance to speak. But the harmonization update, again, this is just a quick one-pager just to say the Phase 1 harmonization is in process at the SDRs, and our focus is on the credit asset class. Phase 2, again, with our credit focus, is in the final stages of ODT review. We've scheduled, we do these bilateral meetings, so we get to meet with, CME and all the DDR and all the other SDRs. So we have these meetings. We're working on harmonization. Actually, I should say this. Somebody said, well, make sure you tell people. I mean, I assume everybody knows what harmonization is all about, but one of the people I was doing this for this morning said, make sure you slow yourself down, tell them what harmonization. Okay, so the point is, just so we're all there, the idea of this is harmonizing SDR data. And the challenge we have is, unless the data is harmonized, if we have data coming to us from different data sets and we can't take those data sets and be able to trace, say, a swap as it moves from one SDR to another, or if we can't have things in this using the same standard language, if we can't agree to what a report date is, if we can't agree to what we were talking about this today at lunch, what an execution timestamp is. Is an execution timestamp at the time that the trade is executed, or is it at the time, or do you keep, but when there's a change, a novation, modification, do you keep the same execution timestamp from the beginning date, or do you let that execution timestamp be every time there's a change to the actual swap? So what happens is there's so many not inconsistencies, but different ways you can interpret the most basic field. That's what gets me when I think about harmonization. I look at these things, I said, it could only, this is so obvious, I don't know what the big deal is. But then when you talk to the SDRs and you talk to people that use this data, you realize, oh my gosh, quite legitimately, there are 5 different definitions for the most obvious field. And so this is the challenge with harmonization. But the harmonization benefit really is to benefit the industry as a whole, and also to benefit CFTC with the ability for us to aggregate the data, to look across all the data all at once. Again, toward that idea of the LEIs and other things, to be able to see a portfolio across a range of SDRs. So that, again, back little background on harmonization. So we do have these bilateral meetings. We are doing independent data quality analyses. Some of you may have seen some of that, that if you've been in our meetings, in those bilateral meetings, discuss. So we're doing exception reporting with the SDRs, talking about them, about exception reporting from the SDRs to the data submitters themselves. We've got we're working on planning a joint meeting with the SDRs this summer about phase 2 harmonization. And we are, and there's not anybody here from OFR, I hope, because where, darn. Well, so because I misspelled OFR, yeah, so I noticed that is the worst thing about quality checks. Clearly, even CFTC has some data quality issues, and this would be one of mine. So, anyways, it's somebody said I should refer to it. We were using the French name when I put the OFR down there, but anyways, it is OFR, not ORF. So we are having a joint effort with OFR. They've been very helpful. They're assisting with the harmonizing of the IRS asset classes. OFR is going to be working with Saeed and others within the Office of the Chief Economist with some IRS research, and the IRS research includes swaps and futures data. So anyways, that is the update on my end, and I will turn it over to others, and then we can take questions. But hopefully, my goal of all this stuff, really, if anything, it's probably this slide here, and it's just to say, to try to give you a sense of our data landscape. When we look at what we have, because we're going to talk in this presentation about what does the surveillance system of the 21st century look like? And so this gives you a sense of the levers. This is the data that we have to play with. And so we can talk about playing within this data set. And I think it's a pretty broad data set. Yes, there's some things that are missing. I certainly, the SDR data is in its infancy, let's say. And then there is, obviously a lot of message data that we could incorporate. But I think that we've got the raw materials for a great surveillance program, but there's still obviously lots of work to do. So
great, thank you very much, George. Maybe some of our SDR friends could reflect. Where are you going, George?
Oh, I was going to slide over there so that the next person who can speak. But I'll
I like the buffer between me and the rest of the panel.
Maybe Marisol, you can give some thought to what we need to think about in terms of how we size that cloud at some point. But while you think about that, we're going to move on to Andrew's presentation from CME to give us some context about how we can work with CME to expand our surveillance capabilities.
Thank you, Commissioner Malia and members of TAC for inviting CME on this panel. I do think that there are some missing levers in terms of what George just presented and what it takes to have a 21st century surveillance system.
Can you just pull that a little closer to that microphone?
Of course. So from our perspective as frontline regulators, the CME Group, Market Regulation Department, investigators and analysts have at their disposal a suite of highly sophisticated tools that they use to monitor and survey and preserve the integrity of CME Group's markets. And we have a level of proficiency with regard to identifying and investigating the types of activity that draw a lot of attention these days, namely disruptive trading practices. So it's from our experiences there that we can offer these three unsurprising factors that are essential to a 21st century surveillance system. First, you need experienced investigative staff. Second, you need systems that sit on top of highly granular and enriched messaging and trade information. And third, you need significant IT support. I am very proud to lead a large team of investigators and analysts at CME. And while George may have said that the data isn't that exciting to the people who are here, I can tell you that my investigators find data very exciting. It's different than it was in the past, where we were looking at trading infractions that occurred during the course of 15-minute brackets. Our investigators today are looking at fractions upon fractions of seconds. Our team that primarily investigates messaging practices, spoofing, flickering, layering, other types of yet-to-be-defined disruptive activity, are commonly looking at data sets with hundreds of thousands of rows of messaging information in single investigations, performing analyses, restructuring the data in order to identify whether there was any disruptive effect in the marketplace, and summarizing that data in a manner that's meaningful to non-investigators and others who have to make decisions based on that data. The important thing about having experienced investigative staff is that they are integral to the development of technology. Our investigative staff works very closely with our IT department and other technical business systems analysts to refine and make better the regulatory systems that we have at our disposal. The interesting thing is that our investigators would be fairly ineffective these days if they didn't have that second requirement, and that's having systems that sit on top of highly granular and enriched messaging and trade information. In 2012, Dean Payton described in fairly granular detail the systems that are employed at CME to monitor automated trading. And I don't want to represent what we presented in the past, but it's important to recap some of our surveillance systems because it'll contribute to the discussions today. Our investigators have at their fingertips a regulatory tool that we call Armada that provides them with order book information, highly detailed order book information that can be viewed either statically at given points in time or that can be replayed to the investigator to observe order entry practices and how those order entry practices impact the market. Our investigators also use a tool called SMART, which is an analytical tool that uses highly enriched cleared trade data, so T+1, which has several functionalities and user interfaces that allow investigators to run predetermined exception reports for identifying activity that fits certain trading practice parameters. Since 2012, when we last presented on this, the modifications that we've made to SMART include adding 30% more data fields that our investigators can look at. Similarly, our investigators use a tool that's called Rapid, which is an in-memory database of all messaging activity that occurs on Globex. The Rapid tool has capabilities of reading and aggregating over 1 billion messages per second, and this tool is used by our investigative staff, particularly with regard to disruptive trading practices, where we are literally looking at message-by-message information, hundreds of thousands of rows of data, in order to ascertain whether a participant intended to cause disruption in the marketplace. Through the use of our Rapid tool, investigators are not only able to see messaging activity that comes through single tag 50s, but they're able to see execution firm IDs, clearing firm IDs, the session through which those orders were generated. As Brian indicated earlier, we can see whether the order was submitted by a tag 50 that generally submits orders automated or through manual means, in addition to several other data fields that are available to our investigative staff. I mentioned that SMART, we have added over 30% more data fields. In Rapid, since 2012, we've increased the number of data fields that our investigators can use by over 60%. The key to those numbers is that in order to have an effective surveillance system today, it has to be adaptable to the changing evolution in the marketplace. It has to have input as to what type of information is important for investigative staff and the type of information that's relied on by enforcement staff in taking disciplinary actions. The third component relates to having superior technology support. So our Rapid system alone pulls in 250 to 300 million inbound order messages on a daily basis. So again, going back to the prior presentation, the bubble would have to be blown out significantly more if the CFTC intends to collect messaging data, not just from CME, but from other marketplaces. I read recently that the SEC's MIDAS system takes in over 1 billion messages per day, and that represents just a fraction of the overall activity in equities markets. So the scale of a system to be deployed across multiple markets is going to be enormous. And that enormity of the system needs to have tools on top of it that can effectively and efficiently pull the data so that people can analyze it in an effective way. The other one final point that I had noted before is on having a system that's adaptable to change. And it's extremely important from our perspective, from my perspective as a regulator, and that's having an ability to take an idea generated by our investigators and turn that idea into some sort of operational component of our investigative practices. And that takes IT support, and often a lot of it. So it's that combination of different things, having experienced staff, having very sophisticated systems that sit on top of highly enriched and granular data, and finally having superior IT support. From our perspective, those are the three very basic and not too surprising elements that the Commission needs in order to have that 21st century surveillance system. Thank you.
Thank you. We're going to go to Steve with FINRA.
Sure. Thank you very much, Commissioner Malia. I'm going to talk. I think everybody's speaking from a slightly different angle here, and I think it's going to be an interesting. This is an interesting panel as a result. And I'm going to take a much more long view in terms of kind of where we're going. And we start to think about what regulation is all about. Now, its foundation, regulation is really designed to ensure market integrity and to protect investors. I'm not a lawyer, and I like to think in simpler terms. And I think about really stopping bad actors and bad practices. At the core, that's really what we're trying to do. But today we do a pretty good job at doing that, but there are some real challenges, I think, that we confront every single day as we think about what can be done and what needs to be done in the future. This morning we talked about market structure differences and micro market structure differences. Each product we talked about has unique characteristics and a unique history that got it to where it was. And they've led to many, many different market structure differences. And that presents some pretty interesting regulatory challenges. There really is, in my view, only one financial market. Most investors and industry participants come to market across products, across markets, and participate in those markets in very different ways. Quite frankly, today, regulatory community does not treat the marketplace on a broad scale in one view. But there are some fundamental similarities to the challenges we all face as regulators. Rules are largely driven in response to issues that we identify. Unfortunately, a lot of those issues are identified like looking in the rearview mirror of a car in the past. They happen, they take place, and we respond to those. The rule environment and fraud protection are really driven by the best information that's available. That tends to be samples and partial views, not universal views. As a result, the process of enforcement of rules and behavior and catching and enforcement of behaviors is long. It requires investigations. It requires looking into many, many, many days and hours of interviewing candidates to piece together all the activities that take place. The efforts are constrained totally on the regulatory side by cost and cost effectiveness issues. Data is difficult and costly to obtain. I think CFTC's found some of these challenges as they try to harmonize SDR data and some of the difficulties in making it happen. But it's also been difficult to use as we bring it together. Many of the people that we use in the regulatory community to enforce rules and regulations have limited information at their fingertips as they go and do their investigations. Regulatory data and its approach it's largely segregated by product and sometimes by market. And when you think about bad actors, many of them come to the marketplace or bad practices across products, which means the views are narrow, but the practices are broad. The great news is that emerging technologies are really changing the game. What is possible today in our regulatory thinking is very different than what was possible even 3 or 4 or even 5 years ago. And as we start to envision what the future looks like for FINRA, and in the, let's call it the cash markets, to a large extent, we think that there is a revolution underway that will change the nature of what regulation can be done and how we can interact with and stop bad behaviors and bad actors. We think that the new technologies will allow us to much more efficiently collect, store, and analyze data. You've read about all these technologies. We talked about cloud technology. There's new other kinds of technology that comes to the marketplace that allow us to filter it, and we're just on the cusp of what will be possible as we move forward in the future. We hope to be able to look at the universe of activity from a regulatory perspective rather than samples of data. And by seeing the universe, we can see broader and much more in depth the activities that are taking place and identify anomalies in the marketplace, integrity issues that we can't see today, and be able to stop them much more quickly. We can be much more targeted from a risk perspective and an observation-focused effort so that we can be much more efficient, not just from a regulatory perspective, but from the broker-dealer perspective and all the participants in the market's perspective. Because our questions will be more targeted, we'll be more informed when we walk in the door, and we'll be able to have a much more fulsome conversation about what the issues are and be able to resolve those issues. 12 years ago, we launched TRACE, our fixed income transparency vehicle. We've talked about it here a number of times. Prior to the launch of TRACE, there really wasn't much transparency in the fixed income marketplace, and regulators had very little information about what was going on in the fixed income markets, except on a sample basis. When we talked to industry participants predicted a marketplace that was about a third as big as it turned out to be when we had the facts, that had about a quarter the number of participants that were trading in the marketplace as turned out to be reality. They predicted that retail customers were not players in the marketplace, and 65% of the trades in the corporate bond marketplace turned out to be retail-sized transactions. Difference between operating with knowledge and operating with extrapolations are very different. And by the way, I don't think anybody in the industry tried to deceive us when we thought about that. I think that each industry and market participants saw the market as they operate in the marketplace and extrapolate that across the marketplace and couldn't see all the facts. It's a much more powerful place from a regulatory perspective in terms of making policy, understanding dynamic situations when you can see the universe of activities. And because of the existence of TRACE, as we talk about some of the important issues that confront the fixed income markets, like best execution and markup issues, those issues we can deal with and analyze with factual information at our fingertips, with historical data that will allow us to make a much more informed approach as we go forward. Today, the seeds have been sown for some of the future vision. And I say the seeds because I think we're just beginning a very long process. The SEC has proposed, and we talked about this a little bit this morning, the Consolidated Audit Trail, or CAT, and FINRA has proposed what we can conceive of as a companion project that we call CARDS, to leverage some of these technology capabilities and to provide a universal view of activities in the marketplace from not just from markets, but from books and records perspectives. We think this is going to allow us to look across a broad range of products in a way we can't see today. We know that CAT, for example, will cover all fixed income as well as equity and options products ultimately. But CARDS will also provide access to information that will be beyond the cash and securities-based products. It will give us a view of many other products that are treated by retail customers in particular, but packaged products and other things that we don't see in the marketplace today that are also potential areas for bad actors and bad behaviors. Second is that we'll be able to target our regulatory resources where we think they can be most productive. We'll be able, by looking at the universe, be able to identify anomalies in behavior, compare across broker-dealers, compare across markets, and see anomalistic behavior in ways that we just can't see today. Third is that we think we're going to be able to speed problem identification dramatically because we'll be able to see things quicker, identify problems quickly, we'll be better informed, we'll be much more nimble in terms of our approach to resolving problems in the marketplace. And fourth is we'll be much more informed in terms of our policymaking and rulemaking. We'll be able to have much more knowledge when we challenge and see issues. We'll be able to respond with facts and figures that are much more difficult to ascertain today and much more complex. And this will put us in a much more powerful position than we are today in terms of making sure that we have informed and thoughtful policy and rulemaking activity. The CAT approach is essentially to collect all orders linked to executions in their various stages and ultimately link that to customer information. I asked a question earlier this morning about Can we view customer strategies across broker-dealers, markets? And quite frankly, we need to be able to reach in and be able to see which customers and which activities are operating not just on a market-by-market basis, but on across products in a way, on venues and broker-dealers in ways that we can identify those behaviors that are in one market may look fine, but when you look across multiple venues may look different. We've had a little snippet of that by just as we've consolidated equity regulatory activity across the exchange markets. We call it cross markets surveillance in FINRA, where we can now look across all of the exchange market, most of the exchange markets, not every single one, but 99% of the markets, including them and the over-the-counter marketplace, and see anomalistic behaviors. For the first time, we're starting to capture things and see things that we couldn't see before. It's a much more effective and efficient way to do regulation. CAT will take that to another level by providing information that will not just link activities across markets, but will link it to customers ultimately, so we can see information and cut across fixed income and equity products from order through execution reports. It will literally change the landscape in terms of what happens on the cash side of the business. Cards, which is newer, and it's a FINRA-based proposal today, not an SEC proposal, will gather information across books and records. And the intention is to have a universal view of the essential activities that are happening at a broker-dealer. Being able to look at position data, margin data, being able to look at customer activity levels, being able to look at things like churning of accounts on a systematic basis to allow us to have much more effective enforcement than we have today. Not that we don't do well, I think that there is room for improvement here. Gives you an example. We've done some proof of concepts here. We had one broker-dealer who had about 100,000 accounts, not a ton of accounts from a broker-dealer perspective, but 100,000 accounts. We identified 13 accounts during an examination that we need to focus on by looking at the universe of accounts. Tremendously effective, tremendously focused discussions. On a more macro basis, when the Puerto Rican bond issues came up as an issue in terms of risk and vulnerability and who held that, we were able to look across a variety of the broker-dealers and very, very quickly and very efficiently identify who had concentrations of Puerto Rican bonds in their portfolios, and allowed us to have much more efficient and targeted conversations with those participants. Very, very powerful, much more effective than we could have been, and much quicker than we could have been in the past. So what does the future look like? What could it be? So we see a world where regulators can analyze areas of greatest yield by analyzing the universe of activities across products, the way that the industry participants and investors approach the marketplace. So for the first time, when we have all of this information in one place, we'll be able to see data the way the participants come to the marketplace. And that means cash, ultimately we hope derivatives in the future, exchanges, over-the-counter, broker-dealers, other actors in a harmonized fashion. We think that the key to this is not just having regulators have access to the data, but to have the legal and compliance community and the firms also be engaged in that. And we think that the firm staff can become the first line of defense, much like we think about community patrols in the police departments, right? They incorporate local people to to identify problem sets. We think that by empowering the firms ensure on a consistent basis, and remember we have over 4,000 broker-dealers that we have to deal with in terms of our FINRA's jurisdiction. We want to empower them with information that will allow them to identify those bad actors and bad practices even faster than we can. Because nothing's better than having them knock on the door and say stop and cease and desist on the spot in ways that we can't possibly do when you start to police 700,000 registered representatives and 4,000 broker-dealers. But the firms can do it if we give them the right tools. So we're reconceiving in the future what that looks like and the balance of information, and want to use that information to be able to empower them in ways they probably can't do today. Bigger firms probably have all that data today, but some of the medium-sized and small firms don't today. We think that our inquiries will be much more targeted, much more focused, which will reduce the time on extraneous issues and much more efficient in terms of not just from a regulatory perspective, from the firm perspectives. The firms will have much more targeted inquiries. And we think that each of those inquiries will have higher yields because we'll have much better information before we start the process. Plus the faster response, as we talked about before, local compliance really will help stop problems before they become problems, we think. Policy making. As we said before, having the universe of activities and being able to see across the marketplace will allow us to be able to make policies based on facts and figures to support our efforts to understand better the impacts of those things and make sure that the impacts of our policies and rulemaking are effective and efficient. So this is not smooth sailing. There are many challenges to accomplishing what we're talking about today. First is there's a privacy issue. We've heard it before. We know it's a privacy issue going forward. And we believe that this data can be protected, that we don't need PII, taxpayer names and addresses and tax IDs to do the kind of analysis we talk about. Ultimately, you may need it during an investigation, but you don't need it during the analysis and data collection in a central database to a large extent. We think that there are many things that can be done that will help us be much more comprehensive as a result as we go forward. There are, we know that as we implement something like this, the model building takes place. There are going to be false positives. We have to tune models. There are times to make this more efficient, and there's an investment that we're all going to make to do that. So it's going to take time, and there'll be new developments as we go forward. Third is that melding this analysis with boots on the ground, and Andrew just talked about the need to have examiners and people engage in this process. There are not just analysts who will do it, but there'll need to still be people who will go visit broker-dealers and go visit exchanges and talk about what's happening and talk to participants to understand and investigate issues. And striking the right balance of what the mix of staff is going to be an interesting challenge for us to know where those levels are. And fourth, and I don't want to de-emphasize it because it's all built on this, is harmonizing data. Data definitions, data cleaning, ensuring that the information is complete and accurate is a critical element of making all of this work. So we need to make sure that we invest the right time and effort to ensure that we have the proper foundations, because if we don't, it's the old adage of garbage in and garbage out. So you need to be sure that you invest the time to think through the issues, harmonize definitions, ensure that the data is comparable, and you know what you're dealing with and how it's put together over time. Last, and certainly not least, is the investment level. And I think that the investments that regulators will make will be small compared to the investments that the industry will make to ensure that they can deliver this data efficiently and effectively. And that's a process that needs to go underway, and we need to be respectful of all of the investment that's got to be made as we trade off time and investment and performance as we go forward. But in the end, we believe the results are going to be dramatic. We think that they're going to be critical for helping to restore investor confidence as we go forward. Regulation will create policies and rules that are more comprehensive and timely. Bad behaviors will be identified more quickly and correctly and more efficiently. And examinations and enforcement actions will be dramatically more efficient for regulators and industry participants overall. In the end, we think that this is going to change the landscape of what regulation is, and we're only at the very, very beginning of this revolution because we're really at the very beginning of what technology can do efficiently and effectively for us. Thanks.
Thank you. Did I read an article, and was it correct, when it was contemplating the cards system that said it would be second largest only to the NSA computers?
Yeah, the article said CAT was, not
CAT
cards.
Was. Okay.
Yeah, I mean, give you an order of magnitude numbers, and just a back of the envelope size of the data that will be in CAT. Just in equity and options, our estimate is north of 7 petabytes of data for storage, and that's north of that. So we were talking about hundreds of millions of how many? It was 140 terabytes of data. Is that what we're saying? So 1,000 terabytes in a petabyte. So orders of magnitude just on the CAT side. Card probably our estimate now is about a petabyte of data. So together we're talking about tremendous amounts of data. And we're talking about, when we talk about ingestion of data, billions of rows of data every day. And we know that the technology is there to do this, and the technology today to do it efficiently is a tiny fraction. To give you a sense of, when we did OATS, originally OATS 3 or 4 years ago would have about 2 to 3 petabytes of data in storage. Just OATS is the audit trail for equities, was about 2 to 3 petabytes of data and ingesting 1 billion rows of data a day. But the cost of doing that in the cloud today is a tiny fraction of what we were spending then to store data.
So a petabyte is 1,000 trillion bytes,
It's 1,000
or
terabytes.
1 million billion, either way.
Yeah.
It's a bunch of zeros.
It's a lot. It is a lot of data.
All right. Next is Rob Creamer.
Once again, I'm Rob Creamer, CEO of Geneva Trading and the chairman of the FIA Principal Traders Group. I'm grateful for the invitation to speak with you today on behalf of the FIA PTG. The FIA PTG appreciates the opportunity to speak here today on the subject of market surveillance. This is an extremely important issue, and the ability to accurately identify instances of abuse and disruptive trading practices in a timely manner is essential to the welfare of our markets. The FIA PTG has urged the industry, its critics, the media, and most importantly regulators to rely on data and empirical analysis before making claims about the health of the industry or any of its participants. Only with data should a conclusion about the fairness of markets be reached. Only with data should the course of action be prescribed, and only with data can the results of these actions be monitored. As markets continue to evolve and mature, we feel that the Commission must be able to maintain its ability to distinguish facts from hyperbole in order to maintain the trust and confidence that our markets deserve. Before I make any suggestions or take any questions from this committee, I wanted to make it clear that until the presentation today, I knew very little about the Commission's current surveillance capabilities or practices, nor did I understand the specific challenges that it must overcome. With that said, the Commission should take advantage of the work that has been done in the industry thus far to address this very similar need. For instance, the SEC has successfully delivered a cost-effective solution for capturing trade data in its MIDAS platform. This should serve as a template or roadmap for the development of a solution to address market data for futures and swaps. When it comes to audit trail level data, fortunately, much of the work in the futures industry has been done by the SROs, which have developed systems to monitor, scrutinize, and enforce the markets on its participants. The Commission should leverage this work rather than recreating it. It should focus its efforts on developing a platform that accurately harmonizes data across venues and acquire or build tools to identify and analyze patterns of interest. This should be done in a manner that preserves the integrity of the data between SROs, allows for rigorous, efficient, and flexible analysis, and respects the confidentiality of the participants whose activity is represented in this data. We commend Commissioner Amalia and this committee's efforts to assess the Commission's ability to surveil today's markets and strongly support the efforts to make improvements where necessary. We welcome the opportunity to assist the Commission in this worthy endeavor. I want to make a point that was a follow-on as well from the previous panel, and it was in a topic of conversation surrounding the movement of trading activity from the floor into an electronic world, and the topic was, and now it's all happening out in these servers out in cyberspace. And I think a lot of people in the industry, certainly not on this committee or dealing with this all the time, but in general, don't recognize or give credit to the fact that in an electronic world, all of the activity of the participants is recorded and kept and archived. And that never happened before. A day after trading, much of that information was lost, conversations that were had, it's gone forever. And there's never been a more effective time at getting this right and being able to do a proper job in surveilling our markets. I also point out, and Brian Durkin mentioned, at least with the Globex platform, a lot of the tags and data that is captured in the system. Many people fail to recognize or appreciate the level of data that's already being captured by market participants like Geneva Trading and the principal trading firms that are members of our group. It drills down on a very granular level and provides an enormous amount of detail. So we strongly support this effort. We hope that we can provide assistance, but we look forward to the years to come and improving this process.
Thank you. Dave?
Thank you, Commissioner O'Malley, for inviting me to testify here, and thank you to the committee for listening and considering these ideas. My name is Dave Lauer. I'm here with CORE Group and also the Healthy Markets Initiative. CORE is a market structure research and consulting and advocacy firm. Healthy Markets is a coalition of firms that we're helping to put together to advocate for market structure changes primarily in the equities market. My background is in technology and trading. I spent 8 years designing, building, and operating low latency trading systems, working very hard on latency minimization, measurement, and quantitative analysis of market data and trading. Some of that experience was at Alston Trading, which is one of the larger futures trading firms out there, HFT. Although my focus was always primarily equities, I do have some futures trading experience. I apologize ahead of time. I will mention equities from time to time. I know that's been beaten a bit. I'll also say silly things like I think the SEC and CFTC need to work together and stuff like that. So today I'm going to talk about, from a technologist's point of view, what I think the shortcomings are of current approaches to surveillance. And I have the advantage of not having to deal with institutional resistance, cultural issues, political problems. So I can sort of speak from scratch. If I were going to do it, here's how I would do it. That may not be practical. In fact, that's obviously not practical. But I'll also talk about what I think can be done today to enhance surveillance capabilities, and also how we can get to where I think we should go for the ultimate 21st century surveillance system. I think that part of that is going to revolve around what I've called technology-centric regulation and surveillance. And I can't overstate this enough, and I'll get into it a bit in my presentation. But it's a fundamental shift in how technology is used and the way that technology transforms regulatory operations and an approach to surveillance. It's something that many firms in the industry have adopted in terms of how they operate, and ones that have generally fallen by the wayside. I'll then describe the surveillance system. I would like to start out by saying it is not meant to reproduce CAT. CAT is something different. CAT is important. I don't mean to denigrate CAT. I think that's where we ultimately need to go, but I'm concerned that CAT is far away. And I think that there are issues that can be dealt with now, and that we should be focused on dealing with those as quickly as possible. Again, as many have stated here, to help with investor confidence issues, to show that regulators are on top of things, that SROs are on top of things, to become, I think it can be stated, to be effective, advanced, and intimidating with our surveillance capabilities, and to be visible, frequent, regular, and transparent. And I think transparency is a theme throughout this presentation. I want to start with a quote from the Director of Market Surveillance Technology for an international regulator. I thought this was just a very important idea. Regulators that are serious about improving compliance and protecting investors must embrace technology and adapt their organizations to the realities of 21st century trading. This will require courageous leadership, a tectonic shift in thinking, and a radical reallocation of budget and staff resources. So what are the shortcomings in our current surveillance systems? I think that we have technology shortcomings, and fundamentally, one of those is an issue of timestamp synchronization and resolution. I know that this was identified in previous TAC working groups, and certainly synchronization across market centers is much more of an issue in equities markets. That doesn't mean it's not an issue here. We are at the point technologically that we can synchronize to the microsecond. I think we were there a couple years ago. I certainly always worked on systems that were synchronized to the microsecond. at least posted about 2009. But that technology is there. It's readily available. It's not expensive. This is something that needs to happen right away if we can ever hope to be able to do effective cross-market surveillance, and as I'm going to argue, cross-asset class surveillance as well. I think that along those lines, the analytics that are being used are certainly effective for some of the things that they're looking for, layering, spoofing, these types of things. But there are more advanced analytics. I recently did a consulting project designing intelligent adaptive kill switches using predictive analytics, using concepts like normality modeling, anomaly detection, dimensionality reduction, unsupervised learning techniques. These are all techniques that are well understood in data science and predictive analytics that doesn't appear to be used actively in the surveillance market right now. I know there are some vendor products that are heading in that direction, and I'll continue to push that not only should we look to SROs who have excellent surveillance capabilities because they've been spending so much time doing that, but we should look to the vendor community as well. There are now companies that dedicate themselves just to surveillance and surveillance analytics, bringing machine learning in for parameter optimization, the things that were talked about by FINRA in terms of how do you optimize and tune these models. Well, there are systems for doing that in an automated way that are far superior to attempting to do that manually and by humans. I think that we should all recognize that there are conflicts of interest inherent with publicly traded SROs, and the general perception in the industry is that leads to poor enforcement, especially with their biggest and best customers, which is why I will advocate for a centralized surveillance platform operated by regulators, though still accessible for SROs, and a way to centralize all of the operations and reduce duplication across SROs, which could ultimately be a cost reduction for them as well. I think we should all be concerned that there's a complete lack of cross-asset class automated analysis occurring right now. It doesn't mean that the data is not there, but it's generally tip-driven rather than algorithmically monitored. And I think that's a concern, and it's almost impossible to monitor it anyway, given the issues around timestamp synchronization and resolution. I think if the CFTC and regulators want to catch up to the industry, which is an oft-stated goal, the way to do that is by engaging the industry in a deeper and more meaningful way than has been done before. I think the Technology Advisory Committee is fantastic, and I absolutely commend the CFTC for doing this and the TAC members for spending their time here. I think that it's an excellent model for how you engage the industry in one way, and I think the same should be done for understanding manipulation, and I think the industry has a deeper view of manipulation beyond just your standard layering and spoofing activities. For example, it's industry practitioners that might be able to explain the math behind how someone would manipulate interest rates across the yield curve, for example, across assets, across products. That's in a level of understanding that's in the industry and that can be tapped and is readily available, especially with proper incentives. And I'll spend a little time on that in a bit. Another issue to highlight is that some brokers, some practices do make it difficult for brokers to properly watch their customers. One example is that some futures exchanges don't provide drop copies to what are called parent participants of sponsored direct access customers. So there's something specific that could easily be changed. I think the biggest issue for the CFTC and for regulators is institutional resistance. Certainly, the size of the problem and where to start is an overwhelming issue. Money and budget is a serious hindrance. As Commissioner O'Malley has said, the CFTC's biggest problem is big data. I think that falls into a shortage of the right technology skills and knowledge and a resistance to a technology-centric approach. And I'll get into what I mean by technology-centric approaches, but the core of it is that technology is not simply a tool that makes existing processes more efficient. It's something that creates new capabilities, new processes, and revolutionizes existing ones or eliminates them. I think that political frictions within and across agencies is a huge hindrance to a proper surveillance system. And surveillance is the perfect example of something where the SEC, CFTC, and SROs should all be working intimately together on a shared platform. And then, of course, as I said before, I think there are conflicts inherent in the publicly traded SRO structure where you would find a lot more investor confidence, a return of investor confidence, if the regulator were able to be on top of things as well. So as I said before, technology is a tool, but it's much more important than that. And this is why we need a new approach to surveillance. Technology has become part of the culture across this industry. The technology-centric approach is critical for success in financial services. There's no way around it anymore. And participants in financial services don't see individual assets. They don't see individual products. They see the market. They don't trade in the futures market in general. There certainly are some that do, but they trade across markets. And I think we all understand this, and certainly most of the people who trade in this room, that's true for them. And it can't be stated enough that you can't do this with attorneys, and that's no offense to GS 13 and 14 people in the room. You need experts. That's what these firms have. That's what they're unleashing huge amounts of money. The best programmers in the world, the best traders, the best engineers, the best DevOps, the best surveillance and compliance technology experts. That's what you're facing. And so that's why I said earlier that a radical reallocation of budget and staff resources is necessary. This is what regulation is going to be in the 21st century. It's a different world. It's not the world of 15, 20 years ago that obviously I wasn't participating in. And I think that never has the need for expertise been greater or the resource gap been wider. So what does this next generation surveillance platform look like? It's got full cross-asset class coverage. And I think that that's the important first step and one that has been missing, unfortunately. Even from CAT, although we say that eventually it should have derivatives in it, to me that's a foundational element. And part of that might be a bias from my experience. I've spent time at firms where futures to equities arbitrage was a primary strategy. And so I understand that market better than just siloed trading strategies within the futures market. But there are other considerations as well aside from high frequency trading. There's broker front running. It's certainly not unreasonable to expect that you will find instances of cross asset class front running when that is not being looked at right now. Obviously, the system is high performance. It's able to do real-time analysis. It has what I've called a strategy or a trader registration and identification system. And that's a problem that has been confronted by many people at many times. How do you identify people? How do you identify traders across asset classes? The large entity identifier is going to do that. But right now, if you want to do that, you can have people register, submit all of the identifiers that they're using, get back a unique identifier that they use for trading across market centers, and have that propagated down in a fixed feed from the market centers to regulators. And that's the same thing that I proposed 2 years ago before the US Senate in my testimony on electronic trading. Excuse me. The next step is best of breed analytics, and I have no doubt that SROs have incredible analytics that they are using right now. There are also analytics that have been developed by vendors. There are practitioners who want to help regulators with their analytics systems, but we don't have a framework for what I call pluggable analytics. That's a standard pattern in computer science, and it's one that needs to be adopted so that people can design analytics who are not a regulator. The public could be designing these analytics. We could be designing contests. You can have people find the best market manipulation algorithm, find the best cross-asset class manipulation algorithm. You get $1 million prize. You would get tens of millions of dollars of effort for that $1 million prize. That's, again, a standard model being used in other industries and even in other government regulators. SROs could use this platform to leverage this platform and reduce and eliminate duplication. It doesn't make sense to have so much surveillance technology. I think it makes sense to have lots of surveillance groups at every point in the chain, from the firm the broker, the SRO, and the regulator. You need people looking at everything, every step of the way. I totally agree with that. But you don't necessarily need this duplication of technology. By centralizing resources, the cost savings is significant. Again, you need advanced machine learning and parameter optimization, and I'd argue that this is the perfect platform that you can use to engage academics and the public. I think there's a data crisis in this industry. There's a crisis on academic research. Every academic that I speak with will echo this, and in fact, it was just recently written about by Maureen O'Hara and Robert Battaglio, whose quote is in my written testimony as well. We have a serious problem in studying markets and getting access to the right data, and this is the perfect example of something that if you open up this platform, and I don't mean access to raw data. I don't want people to think that I'm saying people can download orders with participant identifiers and reverse engineer strategies. I think there are technological ways of providing APIs and examining data in and data out to ensure that nothing is going across the border that has any concerns around confidentiality, but that can still be leveraged as a platform for doing advanced studies by the public, academics, and practitioners. Now, this is another joke, of course, to talk about how long it would take to build something like this. But private firms could have this operational by the end of the year. If they started today, it would be up and running by the end of the year. That's all I know. I've never worked in government. I don't know how long these things take. But if it was me and I was running this project, it would be up and running by the end of the year. And this is just a broad overview showing that you have market centers sending privileged fixed feeds with participant identifiers into a cloud-based computational resources. You have algorithmic analytics, machine learning, trending and alerting, and another important thing is advanced data visualization. I'd love to see what the CME has done on this. I think everybody has done different things with visualization, and this is a world in technology that has become revolutionized over the last few years. Visualization of big data has made tremendous strides, and it's something that regulators should be investing substantial resources in. I keep talking about big data. I just want to take a step back. I know that, Kat, we talk about 7 petabytes of data and how that's an overwhelming amount of data. I hate to say it, but people in other industries do laugh at that. NASA deals with exabytes. That's 1,000 petabytes, 10 to the third petabytes. Other industries, Google, Facebook. I mean, you have people using open source platforms to manage order of magnitude more data than we have in financial services. So I know that the data issues are intimidating, but these are problems that have been solved. So what can we do today? Again, I would urge the industry and SROs and regulators to adopt a technology-centric approach. I think that engagement with the industry in a serious and meaningful way is a critical first step to the CFTC being able to catch up to the industry and maintain pace, and that's what I think the focus should be, as well as making a definitive data set available across asset classes with high-resolution clock-synchronized timestamps for study by academics and the public. And I think that what we're doing here and looking at what data is currently available is also a critical step. I think over time, regulators should become the primary surveillance group, and that can happen with this next generation surveillance platform. And this is how regulators can catch up and can leapfrog the industry. Thank you.
Thank you, Dave. Tribune, wrap it up.
Thanks. We're almost an hour and a half into this, so there's a couple things I just want to say, very quick points. First of all, and that's an excellent presentation. I would like to say that the CFTC actually already does a lot of this. I've actually sat in with Matt Hunter's group before, and a lot of this cross-asset analysis, a lot of the tools and the flexible tools are being built in-house right now at CFTC with very limited resources. Another point I'd like to make is that you have the data. I was going to bring up the data slide. That's one of the best slides I've seen, and one that I'd like to copy at some point. But you're bringing in a lot of data, and you've got the staff, you've got a lot of the analytical tools. My question is are the right questions being asked? When I talk to our market surveillance groups, I ask them, what are you looking for? We can build reports and we can build hundreds and hundreds of reports to look for discrete things, but we want them to focus on like 2 or 3 areas where they want And all of it really kind of goes to is the market performing well? Is the market healthy? And that's the one recommendation I have for the CFTC is just to make sure, don't get lost in the data. I mean, you could actually be like like Russell Crowe in A Beautiful Mind. You're staring at all the newspapers up on the wall, and you're trying to figure out some kind of crazy pattern over there. You don't want to do that. You want to make sure that you have a clear process of how you're going to analyze this and questions you want to answer. With that, I'll throw it out to questions.
Anybody have any questions? But some of the things that I'm trying to think about here, George's slide, massive amount of data we already have, opportunities to do cross-asset, cross-market. How do we bring this all together? Should there be a coordinating structure? Who should really lead this kind of effort? We speak a lot to the SEC, we speak to FINRA, but we're clearly not doing enough to leverage this as opposed to trying to replicate. And I think Dave's slides kind of caught on this. It seems it would be extraordinarily expensive if each of us tried to have our own data set and exclusively try to do our own surveillance and solve all the same problems that each other have already had. So how should we think about this in terms of priorities? Should we have it all? How do we work with the SROs that do serve as the front line regulators to rely on that? Another question I have is, and for you, Rob, is with the order message data. Is it something moving to the next level of order message manipulation? What do we need to think about in that area? But those are the couple observations I have. I see there might be a slide or two coming up. Who's down there? I can't. Is that Jeff or is it? Who's got? Oh, both of you guys. Adam's got a tag up.
So I had a question actually along the lines, some of what you were just saying, along the lines of cross-agency cooperation. When Dodd-Frank was written, it was envisaged, although it didn't, started out with the idea that there would be something called the National Institute of Finance, which kind of morphed into the OFR, but without the full vision that was behind the National Institute of Finance. And they were supposed to be a systemic risk agency collecting data and doing research on systemic risk in the markets. You have about 4 organizations here that are all collecting data based on surveillance to some extent, market manipulation, rather than systemic risk. But as you said, you're all interested to some extent in the same data, not to mention whatever you would do in cross-border cooperation. So I guess the question is it possible politically? And I'm sort of gonna ask Bill, because he's the one stuck at the OFR. Is it actually possible politically for these groups to get together and share?
It's not possible politically for me to answer that question. George, I just have a procedural process question for you. How are you conducting the harmonization process? And are you going backwards to the sources of data, back to the participants? And then my second question along that line is, can you help me understand the definitional problem that you're facing? Or is it a nomenclature problem, or is it an alignment to meaning problem? Because it seems to me that all these data attributes are contractual. They are defined in the terms of the agreement. And I'm just wondering what the nature of that definitional challenge is.
Sure. Well, I'm actually going to throw this over to John Rogers, who's been overseeing the harmonization process. So John is our CIO.
So that was good. Question one. George promised me that he was going to do this. So let's see. I think that it's really not so much a nomenclature, issue. It is really, I forget what the other choice I had in answering your question. Meaning. It is really a meaning question, and it's not so much it's really about how each of the SDRs are populating this data, and which of course is data that they're getting from the submitting parties. And does it actually mean the same thing to, across the board, across each of the SDRs? So the harmonization is to make sure that there is harmony in meaning. And while there are rules that talk about what each attribute means, each field means, there are interpretations of those rules, because people, as we all know, read words and derive different meanings from words. So harmonization, first and foremost, is about the SDRs and CFTC getting together and making sure that we all have a common understanding of the meaning from our perspective, so that when we pull the information together, we're expecting to see things that mean the same thing. Doesn't mean that one interpretation was more correct than the other. It just means that now we have a common understanding. So that is a lot of what this is about. As far as who is interacted with, the focus of our harmonization effort has been on our interaction with the SDRs, but we know that in many cases, this information is filtering back to the people that are submitting the data. And there is an interest generally, or probably largely, in making sure that the consistency starts at the source. But our focus has been, at least to this point, on the information that we are looking at from the CFTC and making sure that there's common understanding of a common meaning across all of the SDRs.
Satek, there are also efforts that we should be undertaking with regard to harmonizing internationally. Europeans have had reporting since early February. Other jurisdictions are bringing on their SDRs. Something that we're not moving quickly enough on is setting up international agreements to share that data, and there's no agreement required today if we wanted to begin harmonization efforts across jurisdictions. That would be a worthwhile effort to at least make sure that when we do get to a sharing arrangement, that we're comparing apples to apples. Steve, and then Walter.
A couple of things. First, let me correct a couple of data points I put out there for you, or clarify them. I actually, while we were hitting, I had somebody actually pull out the CAT RFP to see what was required at year 5 of CAT. It's 21 petabytes of data required for storage for the CAT RFP, and the ability to process 95 billion rows of data per day. So the plans are large. And I would say Dave, is that we have actually talked with every major technology vendor and many minor technology vendors about the problems that we're dealing with. And quite frankly, they all think that we are on the very cutting edge of what technology does, and close to the bleeding edge in terms of some of the challenges that are in terms of processing and doing the data. So it's not just about ingesting the data and storage, and we use those things as relative measures for people, but it's how you got to match the data, bring it in place so you can use it and leverage it, that becomes tremendously complex, and do it on the fly, where if you have one problem any day, you back up, becomes an enormous task. So the nonstop processing of that becomes a problem also. But let me try to address the issue of working together. And I think that the thing we have to be very cautious about, and I think I can say this from an SRO perspective, it's harder to say from the government perspective, I think, is that we've got to be careful not to try to boil the ocean, what I call boil the ocean, when you start to harmonize data and get standard approaches. I think we have to look at what our purpose is in regulation and make sure we're thinking about those purposes. And as we harmonize those efforts, we have to harmonize certainly first across what the markets regulatory, the financial services regulatory community needs first. Because if we're not careful, at least in my experience, both on the industry side and now on the regulatory side, is that many people will look at data and define it differently. The same field could be defined for different purposes. And the more you try to satisfy everybody's need, the less likely you satisfy anybody's need. So we have to keep in mind what our purposes are. And it's one of the barriers to moving quickly sometimes is everybody agreeing. And quite frankly, we got to remember that when we do collect the data, the industry has an enormous problem delivering it also, because they've not compared across firms. So much of the data that we use is data that we gather from broker-dealers, not just from exchanges. And when you do that, every broker-dealer gathers the data for their own purposes and not for our purposes. And going back and getting them to modify that in a way that is consistent is really what slows the process down, much more than what we might think of as bureaucratic action, because getting all the data in a place that we can use and leverage is a critical element of making this work. So you can't underestimate the challenges to ensure that everybody can deliver the information you need, understands it, and then actually executes properly around that. It is a daunting task when you start the process. And the broader we get, the more we cut across markets, the more complex that becomes.
I think Steve actually touched on, at some level touched on what I was going to say. I was going to start off with the smart alecky remark that if you can't even agree on timestamps, you're a long way from agreeing on the terminology of contracts in sort of straddle swaps and whatnot, and trying to standardize on that. And what I'd like to know, first of all, is from what Dave said, is it true these markets do not even have a consistent clock? If that's true, what's the obstacle to them having a consistent clock? And is that, in fact, part of one of the first things that you'd want to do in harmonization? It seems to me, as Steve was saying, don't boil the ocean. Start with something that is very tangible. I know that when we did the flash crash study, one of our problems, many issues, was simply that not only did we not know what the timestamps necessarily represented, but different exchanges had different interpretations and ways of representing data about when a hold was placed on trading. So there's some very basic things about timestamps and events at timestamps that it seems to me would help a lot and seem quite tractable. But you're not going to get everywhere at once. And so once again, I'm just directing this kind of at John. Is there something you can do in the short term to get started on this?
Maybe on the timestamp issue, we could ask somebody who's got some skin in the game, maybe Chris or Rob, how you deal with timestamping. Do you do your own timestamping, or do you accept the exchange timestamping?
Pretty much. As far as we do it, we look at each exchange, and obviously everybody's reporting times that are different, and we try to normalize them ourselves. And it helps in looking at trades in a post-trade analysis way. But yeah, I think it's extremely important that from a regulator standpoint, that you're able to take a look at trades that are going to match up with one timestamp.
As I saw flags go up, I think it was Keith, Chris Kincannon, John Lothian, Marisol, and Richard. Am I missing anybody? So Keith, you want to make your comments?
Sure, I have two comments. You had mentioned timestamps, and I think Dave, you might have been referring to the working group that Chris, myself, and George was in. We presented probably the first kind of alert on timestamp issue. And it's not that you can't synchronize server clocks, it's that they drift after you synchronize them. So you can get actually deviations of milliseconds, not microseconds.
Just to speak to that, I mean, there are technology solutions, and they have been around actually for quite some time.
You can sync them, but then the clocks themselves drift.
They absolutely do.
So, and they drift at different rates.
But if you have this is it's a problem that's been solved, and everywhere that I've operated at has been able to solve the problem.
All I can do is alert you to the issue, but the other comment, excuse me, is the issue of in terms of data and the data meaning, which I'll throw back to George, and whether you ever anticipate coming to a conclusion with data meaning, or whether it will just go on and on.
So, all right. So as far as data meaning, John, I pointed to John, and John pointed back to me. So I guess I have to take this question. Anyways, yeah, the I think the clever way that the folks in ODT have been sort of facing this question and how we've been dealing with it is the whole idea of the phased harmonization process, I think, is a good one because, yeah, we don't want to boil the ocean. There are so many different fields that one could go after. So the idea with the phased harmonization that we picked, I forget what it is, 20, 30 fields in phase 1, and then another 20, 30 fields in phase 2, and then there's phase 3 and phase 4. But the idea is focusing on the most important fields first and focusing on those and trying to get standardization. Will we get harmonization completely on every field? It's there's always going to be new fields that are going to be invented. There's always going to be innovation when it comes to the financial industry. So you're never going to be done. But the key is to try to get the most critical fields harmonized so that we can have a agreed upon ideas. And John, you look like you're about to say something, so go ahead.
Well, I just wanted to add, and in harmonization, we are looking at things like clocks, not necessarily millisecond drift, but standardization, as much as we can. In some cases, there are questions about milliseconds and microseconds and those sorts of things. But those are the kinds of things that, just one example, when we're talking about timestamps, that we're focusing on.
And I had one more comment that something that Steve had said in the issue of false positives. And I realize that these programs of trying to collect all this data is really going to be quite costly to all the different regulators. And I'm sure that you're going to really look at the expected benefits before the large investments. But I wonder if you're going to look at the cost to firms of dealing with false positives.
Yeah, very quickly. I mean, the answer is absolutely. We need to think about that, and we are thinking about it constantly. And as we bring the data in, we have to be very careful that we minimize the disruption to firms. But we have to work together. And the concept is, and I think Dave or one of the participants talked about how important it was for the industry to work in cooperation with us. Because if we do it together, we're much more likely to minimize the disruption and minimize the false positives as well as false negatives, and of course that to be sure that we're getting an effective tool. So I think that absolutely we're sensitive to that. Absolutely we consider that. Absolutely we need to work together to be sure that we minimize that process.
Chris Concannon.
Thanks. Just quickly, there was a recent book out that claimed that the exchanges didn't have sub-second data on activity. I'm just curious, it sounds like you actually do have sub-second information.
Sub-second meaning less than a second?
Yes.
Yeah, so our regulatory systems maintain data down to the millisecond. And within milliseconds, we were able to sequence events so we can tell which event occurred in priority. So it gives us microsecond level sequencing with millisecond timing.
We do the same. We use a visualization tool called Smarts that we can look down and see how trading is done, right down to the trade by trade, order by order level. So.
Right. I guess the author didn't actually speak to anyone in the industry about his claim. I have a second question. Is just with regard to the CME and bond futures, where you do all your surveillance, obviously on the Treasury futures, the bonds, and correct me if I'm wrong, Steve, but Trace doesn't actually collect information on Treasury trades, cash Treasury trades. Is that they don't? So does anyone surveil the Treasury market today, other than the bond market? It's one of the biggest asset classes on the planet. Just curious if anyone surveils it. Okay, yeah, I don't know. Yeah, a lot of people trade it. Maybe retail's involved, and just curious. That's all. Thank you.
Mr. Lothian.
Steve, we heard about, or you talked a little bit about some of the problems of adding in data as you're getting it and reassembling the data. I wanted to ask you, one, where are you guys at in terms of looking at day-to-day data? Okay. Sometime back, a couple of years ago, I was told that you were somewhere and so it's probably 2012, that you were somewhere in 2007 in terms of looking at the data day to day. The other question I have is the flash crash. How long did it take for you guys to assemble complete set of data that you could say deliver to the to the SEC or share with other parties, comparable to what we heard with Brian with the futures markets?
Sure. Actually, I'm not sure where we got the 2007 number from, and I'm not really sure what that refers to. But we ingest data every single day. If we fall behind, we can never catch up. So we are current in the data we bring in every day. There have been segments of the markets that have had difficulty submitting data to us from time to time, that we work through those problems, and sometimes certain segments fall behind, and ultimately we can catch up with them. But if we had an overall market problem where we couldn't ingest data quickly, it'd be a problem. From an analytical perspective, some of our patterns are relatively current, meaning day-to-day. Some of our patterns look at historical behaviors that run across multiple days or multiple months in time series. So they're looking at data over time. So they don't look at data every single day. So different patterns have different kinds of timeframes and periodicities in which they work. And we look at those appropriately based on which the behaviors are we're trying to catch and what data we need to put together. We in general think we're pretty current and try to maintain currency with our ingestion. When you're saying we, I think you mean FINRA in terms of what we're talking about, right? And keep in mind that what we're talking about is the markets that we surveil for. Does that answer your question? Is that
right? There was a question about May 6, 2010, how long it took to get a complete set of data to be analyzed.
Yeah, I don't know the answer to that specifically. I can't answer that. I can probably get you the answer to that question. The question really starts with is what was it that people were looking for in that point in time, and I don't know the answer because I wasn't directly engaged in that. I just don't know.
Okay.
Maris, I'm sorry.
Just a quick question. This may be naive, but the question was asked about working across the different agencies, and I don't know why you folks, Commissioner O'Malley or Acting Chairman Weejan, the question wasn't posed to you. I'd be curious as to what I don't know the answer to the question. Like, what's the roadblock to, or is it happening, or what your thoughts are? Because I think Dave understood about half of what you said, but I think he was as much a solution driver as he was a, hey, here's the problem. I thought a lot of what you said was, let's go get the solution. And so I struggle a little bit trying to figure out, we have some of the actors in the room, why can't we get an answer as to why we can't get this cross-agency? I mean, I work for a small hedge fund. I can't run multiple silos. It just doesn't work. My data has to be put it in a world of regulatory reality. If I don't use a common data set, my regulatory risk is exponential, meaning that if I drive a different data set for marketing or if I drive a different data set for regulatory purposes and I can't explain that difference, it's career ending. So I think, Dave, you were spot on a lot of what you're talking about. Again, I don't understand all the high level or the granular stuff, but just back to the point, why is there, can you speak, either one of you, as to if there's resistance? Is it possible? Because this seems so intuitively correct to align the interests.
In my somewhat limited experience with this, we've entered into a number of information sharing or data sharing agreements even since the beginning of the year. I think the observation made over here on this side of the table has been accurate in the sense that if it tends to work more easily and comes together more quickly if it's rather targeted in nature. I don't think it's a political issue. It's the obstacles we run into are legal ones, and that's true on the international front too. But we have Section 8 requirements under the Commodity Exchange Act that requires us to protect and keep confidential any information or data that we have here at the agency. And so that places limits on how and when and what we can share with other domestic regulators. And the same is true on the international stage as well. And to further complicate it, there's a variety of jurisdictions in Europe, some of which have even more stringent global, if you will, privacy protections that make it rather difficult to enter into these types of arrangements. So I don't think it's politics. I really don't. It quite literally is legal impediments that have to be managed and worked through. And as I said, we've done it. We have arrangements with FERC in place, a couple of them, and we're working on another with a different regulator. So it's possible. It's been done. It's not always terribly easy, but it certainly can be done.
Yeah, I would kind of go back to the flash crash as a good example where a crisis did catalyze action. And we shouldn't have to have a crisis to do this. We probably, if they are legal challenges, what are they? Let's put them on the table. Let's start to work through them. I think we're leaving a lot on the table right now if we stick to our little silo and at least not think about what the other options are going to be. And I know we do have some creative surveillance people that are trying to look at cash markets, looking at alternative markets and things like that. But I don't think we've done enough in this area.
Yeah, I mean, just as a small, again, I work for a small hedge fund. I mean, the regulatory cost is extraordinary. And having to sit with multiple regulators and answer the same questions, but not have a centralized, it's amazing to me. And I think there'd be huge pickup for multiple reasons. So I would, just as a TAC member, if there's any way to solve some of these legal issues, I think it would go a long ways to creating a very efficient, more robust process. I guess that's about all I have to say. But again, Dave, I thought you were spot on.
Can I just say thank you for that? And you know, like I said, I have the advantage of kind of coming at this fresh and more from a technology perspective than a legal one. But I do know from what I've heard that the Joint Advisory Committee was a very effective vehicle for working together. And I hope that might form the blueprint or the framework for, as you've said, Commissioner O'Malley, instead of it being an ad hoc thing for crisis response to being an ongoing effort, and that might be the right way to approach it.
I'm sorry, I wanted to add one more thing. Steve, it might be worthwhile, Steve Reich, sorry, yes, if you want to talk for just a minute quickly about the interaction between CFTC and FERC and how that's worked in the last couple months.
Yeah, I guess this is since the last, the end of March, we've been getting a regular data feed. As you can see, it's not a large portion of what the CFTC has, but it's vital to us in terms of putting together our surveillance process, and it's essentially become a keystone in terms of what we've needed to be able to build out our surveillance process in kind of our little corner of the markets, which is much more limited than most of what everyone's talking about here. But I think we're a lot more thorough because of it, and I think Commissioner O'Malley and Chairman and George and John have been very helpful in working with us and getting something up and running. So now it's extremely smooth and useful.
That's good to hear. I'm going to go back to the order. Marisol, Richard Gorelick, Pierre, and then Brad Levy.
Okay, so thank you for facilitating this discussion. I think it's the harmonization and the data quality and completeness are key. As a swap data repository, we've certainly been engaged with the Commission and with the industry. I actually do have to compliment, I think we've had some meetings most recently where the Commission, George did some amazing presentations as well around data. And I think it does highlight a few things that we need to be thinking about. And what I would first start with, it's not just the Commission's problem, it's not just the SDR's problem, it's not just the industry's problem. We have to have much more of a collaborative approach here where there is a view of the data set. What are the challenges? So Mike, you asked the question, is it a data meaning problem? Is it a content, is it a format problem? I actually think it's a combination of those things. I think one, we have to deal with the interpretations, and in some cases interpretations vary. And execution timestamps are a very good example of that, understanding that's a high priority, we find edge cases or certain cases where you go, well, what do you do in these scenarios? So how do we tackle that collectively between the industry, the SDRs, and the commission? The other is around the completeness of data. And those are more things that you can do around the validation. But again, it's easier said than done because you can always find examples of where those challenges exist. So, I guess my comments are really not to go into all the details that underline that, but there's really a few themes around it. And what I think is important, and perhaps taking a page from the large trader reporting, is there was active engagement by the CFTC with the industry. I think it would go a long way to have that type of active engagement once again between the SDRs, the CFTC, as well as the industry, to go through those key data elements and understand. And again, it's sort of the keep it simple principle. I'll save the last S, but it's really about, let's focus on a set of key fields. We've started with credit. We're looking at the harmonization fields there. Let's look at what other fields, engage the industry. I mean, the industry is known to rise to the challenge where if data fields are understood as to where is it not going well? Where are the issues occurring? And the analysis proves out some of those conditions, then you can actually start to get real engagement, understanding of meaning, right? So you can have a clarity across the industry as to what the challenges are there. Recognition of market structure. And I'm going to go back to market structure quite a bit in that these things just don't magically happen, right? It does take time for that meaning to translate into what is the right market structure that exists for making sure that data comes through in a clean and accurate way. And with that, it's recognizing the process flow. And I know that we've just sort of, the Commission has received many responses on the concept paper regarding trade reporting. But I think process flow, looking at cradle to grave, the audit trail. And I think there's a key consideration that the Commission needs to give some thought to in terms of surveillance, bringing this back to the surveillance piece, which is there's two approaches in terms of efficiency and cost. And one is if you deal with the process and the market structure, you can deal with the efficiency and cost from the perspective of how is it that the SDRs are able to have that full audit trail for a trade ID from cradle to grave. And if you focus on that objective, then what you're doing is you're really placing much more of that effort on the SDR itself. So I would say when you're looking at the efficiencies, that's a particular area to look at balanced against the cost. So I'll conclude there. And one other thing I would add is I think continuing the work on the data standards is key, because I would say another challenge is now with Europe we have a different version of trade IDs, and that just, again, kind of adds to the complexity of reporting for the market participants.
Thank you, Marisol. I know we're a little over time, so I'm going to hit Richard, Pierre, and Brad. I don't know if, Brad, you still want to make a comment. If you can just keep them tight here.
Okay, thank you. As Andrew mentioned and recapped, at previous meetings of this Technology Advisory Committee, the exchanges have detailed their extensive surveillance programs. In the interest of time and cost, I would urge the Commission not to reinvent the wheel with redundant, built-from-scratch, in-house, boil the ocean audit trail systems. Instead, I would urge the Commission to work with the exchanges to figure out how to improve the Commission's access to the tools available at the exchanges today and the Commission's understanding of how they can be used. One related topic that's been raised repeatedly is whether there should be a new registration requirement for high-frequency traders, presumably in part to help the Commission with its surveillance efforts. We've talked here at some length about the significant definitional challenges and the potential for that approach to create inconsistencies and loopholes. My view's always been that surveillance should instead be broad-based and focused on questionable behaviors at any frequency. We should ask simply, and I think this committee is a good place to do that. What specific information does the CFTC lack today that would be helpful to its surveillance programs? I believe that most of the information that the CFTC requires is available to it today in current audit trails and in exchange membership files. If there are other types of information that would be helpful, let's figure out how best to get that information quickly and at a reasonable cost to the Commission. It would be a shame for the Commission to spend several years and many millions of dollars to create a new regulatory framework and to build costly processes and systems when it could be appropriately surveilling the markets today with a better understanding of the tools already available. Thank you.
Yeah, thank you. I will be brief. When I look at this slide from George, which is very interesting, thank you, the question comes to mind is, do you have all the information that you need? Because you're collecting a lot of information, but the key question seems to me is, are you missing data points, or is the only issue harmonization of the data and having the tool to analyze the data, which is, are you collecting all the data that you need? So that's the question one.
Yeah, so
the second question, which still relates also to the question of what do you need exactly, is on the CDS activity, in which you have been just looking at these data for quite some time, and it seems to be focused on meaning. Could it be that it might be useful to re-engage market participants in terms of what do you need exactly? And then market participants would be able to work together to say, well, based on what you need exactly, this is the set of data, and depending on the use cases in which we could provide you the exact data point that you need. Because there could have been in the past some ambiguity in terms of, I need the data point, but if you're not crystal clear as to what the need exactly is, it could be that there could have been different interpretation as to what should have been provided.
Great. I think you've raised two good points, Pierre. I mean, do we have all the data we need? We have a lot of the data we need, but we certainly need more. I mean, we've talked about the fact that we don't ingest the message data currently, and I would venture to say that you've sort of nailed it on the second point, which is to say we're at the infancy of the swaps data. You know, we're pulling it in, and we still have harmonization issues. So I think that that's an area where there's a lot of growth in terms of data that we need to pull in. And I completely, this is my opinion, certainly not the CFTC's opinion, so I'm just speaking for myself, but I'd say, yeah, absolutely. Industry engagement is critical. I mean, you guys live and breathe this stuff, and we can, you know, a collaborative thing will certainly benefit with that. So I like where you're going with that.
Sure, thank you. So there's been a lot of talk of chasing what is really the holy grail, which is cross-asset, global, and cleanly linked to a global LEI. That is the perfect, and the reality is the perfect is definitely getting in the way of the good. We ourselves have done a bunch of analysis, number one, because we run a risk platform, but we've also just done some generic analysis on the systemic risk side and built some tools around that. So our view would be, and this is where I think the false positive issue can turn into a net positive, which is start to impose that on people. Use the data you have. Go out there. Don't arrest, sanction, you know, really go after people, but start to try to use the data. That will be a very effective self-cleansing when you start to talk to people about the limited data that you have as one regulator. The OFR is clearly, at least for me, the entity that is designed to be the systemic regulator above it all. But in terms of surveillance, et cetera, just start to use it. People will push back. They'll say you don't have the right information. And then over time, the data will become self-cleansing instead of solving for edge cases and perfect harmonization, standardization. The reality was in 2008, we didn't miss the edge case. We didn't miss the tail. We missed the whole body. And that's pretty much, at least for me, what we should be solving for. And then over time, you can solve for all those other cases. But if we're trying to solve for 2008, we're currently solving for something quite different than 2008.
Any other final words on this? I just want to let everybody know that around the technology and the integration and the data questions, I think this is the beginning of a debate, an important debate for the Commission to think about where we're going to go, how we should think about integrating with other regulators. And to continue this debate, we're going to set up a website within the TAC website on cftc.gov, go to the TAC page. There will be a new link starting today, or I think it's already up there, that we're going to take comments on anybody, any vendor, any technology expert, any data expert that has an idea about how we should solve this problem. Dump it in there. It's going to be dumped in with everybody else, so don't put anything proprietary in there. But, you know, give us something to work with. We'll share it, try to share it among the commissioners, and certainly share it within the commission, and see if we can work with something there. We have, and I receive on a regular basis, many good ideas. And I'm just not in a position as one commissioner to necessarily adopt it and sign a contract, et cetera. But I think it's one of these things that today's debate really kicks off the exercise that we can think about what's possible, what do we need to think about, what are our priorities, how much should it cost, where should we go, who's got the expertise. And so for the next 60 days, we're going to leave that website up there. And if we get any hits and some information, go ahead, dump it in there. We'll see what we can work with. We'll work with all the divisions to see if there's any interest in it. But hopefully we'll get some leads on that. So let's take a 15-minute break, get back here at about 1:45, and take on panel 3. Thank you. Okay, panel 3, we're looking at the CEF data and seeing where we are to date in terms of CEF trading, and what it's going to take to get a little more buy-side participation and, frankly, greater participation at all levels on swap execution facilities. And to kick us off, we have an overview from Claris Technologies. Todd Skorecki is going to, Senior Vice President of the Americas, is going to provide some background on what Claris has put together in terms of looking at CEF data using the real-time data, Part 43 data. And it's been interesting to follow kind of their blog, which they do a tremendous amount of work on. And it's almost seems to be crowdsourced. And I know they're not the only people do it. I know FIA is doing it, ISDA's doing it. But it's been interesting to read some of these blogs as they tackle some of the issues with data quality, data integration, cross-market checking, trading on CEFs, et cetera. So I suspect we're going to see the refined research such as it is. But it is an interesting process as everybody wrestles with the real-time data to divine trends and to see participation and look at who's trading. So I'm very sympathetic to data quality issues and the challenges they have, and I enjoy kind of learning about it as they learn about it firsthand. So Todd, why don't you lead us off with your slides?
Thanks, Commissioner. So again, so I'll begin. I'll look at, again, this is the public data. This is the data that everyone out there has access to go look at. We have no privilege to go look at Part 45 or more, private data. So who am I and what's my firm? So one slide just so you can place who we are, right? So we're a couple-year-old firm. We're 100% employee-owned, employee-funded, and we're delivering technology in this space of SDRs and CEFs. Importantly, being employee funded, we began off with a services arm, did some consulting. The goal of our firm is to provide some cloud-based credit risk, market risk technology. But in the past 2 years, we ended up having this world of data fall in our laps, right? This world of public data. And so we began publishing, like the commissioner said, publishing some blogs, but also a product that then aggregates and simplifies some of the collection and presentation of the public data. So that's what we're going to focus on today and why I'm here. So Data 101. This is the basics, guys, right? So there's the world of the swap market, right? The big pie out there. And then importantly, and this does get confused by some people I speak to, but then there's a smaller oval, if you will, in this case, an orange oval, which represents what's reported to the SDRs in America, right? So trade repositories across the world might be getting some of the rest of that pie, but certainly within America, everything's being reported to that sort of orange circle. And then importantly, a subset of that, of course, is then CEF data. What is transacted on CEF? So what are we looking at when we look at the data? So what's available is Part 43 data. That's the publicly disseminated SDR data, and that's from the four usual suspects. we're collecting from. And then there's the equivalent sort of Part 16, publicly available Part 16 data for CEFs, which are coming from arguably 24 different CEFs. Of those 24 that have registered, 22 have been approved, and as many of you know, 16 CEFs have actually done any activity, right, and produced actual reports. So it's these sort of 20 different sources of data that we're getting the information from. And then, so what's the difference between these two data sources, right? So the SDR, it's trade level data, whereas the CEF data we're collecting from CEFs tends to be position based. The frequency of the data for SDR is, intraday. You'll see it. You can do a trade and you'll see it pop up on a screen a minute later. Whereas CEF data is end of day. The format of the SDR data, varying between DTCC, Bloomberg, and the others, it's more or less common. I've called it somewhat common. Whereas the CEF data, there's 24 CEFs, 24 formats. One of the things that people like to look at the CEF data for, however, is that you can see full transparency into the size, right? So you get the full notionals being revealed, whereas on the SDR you see a lot of capped transactions, which is an attribute of a block trade. And you can, of course, see what people want to see, which is what CEF is it on. The public data for Part 43 does not tell you what CEF, okay? And there's other things people want to see. They want to see, is it a dealer or client trade? Is it the dealer paying or receiving, much like you might see on Trace? And also people want to see, is that part of a package? So without tricks, you really can't get to this information right now on the public data. So then let's jump into the data. So what does this tell us, right? So for credit first, we'll look at one of the MAT products. Credit's generally a happy story. We're looking here at the IG index, which began on the very far left in October. The CEF participation, if you will, or percent of on CEF trading is that green line that you see began right about, I'm going to say 40%, dipped down, and now it stands about 80 to probably 85%. In terms of trades, it's much the same. I think that began at about 50%, and I think that's now at 88%. For just this one index, this is a matable product, and you can see, the sizes and the trade counts there as well. But that's a general positive story. And I won't bore you with the other details of the other sort of matable trades, but if you do look at those, this is a summary of those, right? They're all, both IG, the iTrack series, they're all that similar kind of upslope. So I guess the important question is then, well, hold on, even if it is only 12% that's off CEF, what is it, right? So we look at that sort of tail. So that big blue bar, if you will, that you're looking at in number of trades, the big blue bar is on, everything out to the right is off. What I break it down there, we look at, some of this is block, some of it's not 5-year, some of it's not on the run, or the most recent on the run, right? So if you go down that list of criteria of what is matable, those 12% demonstrate at least one of those criteria. And so in that order, we can see that most of them are block size trades. And quite frankly, there's stuff you can't explain, right? And that just from the public data might easily be packages, right? Exemptions, things of that nature. FX, one slide here, just because it's worthy to mention that this is not a required trade. It is permitted, obviously. It's not. It's available to be cleared, but not mandatory cleared. And you can see just a disparate results on CEF, right? If you look at the Peruvian currency, that NDF is very, very high on the ranking of percentage on CEF, whereas dollar MEX is at the very bottom, right? I'm not going to offer any explanations for this, but I thought just in the context of presenting credit and interest rates, I thought it'd be worth to put that up. So moving on to rates, which is where I think it's more interesting. So we'll look at first the US dollar, and this is again the same kind of chart we looked at with credit. And here the sort of uptrend is a bit more gradual, but this began a bit higher, began about a 40% adoption rate in terms of trades, and is slowly grown now to, I think the number we're going to look at is about 52% of all fixed float swaps in US dollars are traded on CEF. looking at similar profile for euros. I'm not going to offer the explanation, but I think many people could probably guess why that's significantly lower. Sterling, of course, trending much lower as well. And out of curiosity, I found yen to be interesting at a fairly decent percentage, 45% or so. But so there's the general trends. Dollar being that blue line on the top left and the bottom right, hovering around 50% now. So it's the same question we looked at for credit. Like, so what is that remaining bit, and why isn't that on CEF, right? So the color scheme here is the same, right? On CEF is blue, and we're looking at, well, what are those mattable characteristics, right? That these trades fail to meet, or why aren't these on? I mean, you can still put permitted trades on. And we quickly find out that there's a good chunk that is uncleared. There's a good chunk that is not mattable index, might be 1 month LIBOR, right? Non-mattable tenor might be a forward start, and so that explains a great portion of this. However, as I say here, it depends how you peel the onion, right? So it depends what you look at first, because again, the off-CEF trades demonstrate many of these characteristics. So if we instead look at the first attribute being what is a non-mattable start date, so what are the forwards, if you will, right? It turns out then, if I'm using my mouse now, this big red bar, right, demonstrates the forward start portion of the universe of dollar fixed float swaps, and what we find is that accounts for, of course, a drastic portion of what remains off CEF. So on to, I guess, the question. I have two anecdotes that I'll wrap up with, right? So the question being, talking about buy-side participation, the first anecdote is that firms are avoiding CEFs by changing the dates on trades, whether they be changing the forward start, doing some kind of, changing the maturity, 30-year in 1 day swap, right? So is that backed up by the data? So again, I refer back to this list of sort of mattable characteristics of swaps, and I look at the trend from October to May, and in the very first line we look at what is a forward. We know that in May 2014, 72% of the off-CEF trades were forward start. In October, that was 54%, right? So there has been an increase, right? And you can see the change in non-mattable tenors, right? So that could be a 30-year in 1 day, right? Arguably, and again, a trade can demonstrate one of each of these characteristics. It can be a block, uncleared, 3-day forward starting, 9.5-year swap, right? Which is why those don't add up to zero. But it is interesting to see that a large percent of it is forward start. So quickly, I guess the answer would be, there is an uptick. There's a change or an increase in forward starting swaps. However, we have to realize that that percentage is against a denominator, that denominator being the world of off-CEF, that is shrinking, right? So I will tell you that in actual terms of trades, the number is increasing. There are in fact more, we're observing more forward starts occurring. Not to accuse anyone, because the final point here is we don't know if this is even client trades. This is, again, the universe of trades on CEF, or in this case off CEF, that we're looking at. And so we don't have that transparency into dealer or client. But it seems to support some evidence of that. The other anecdote is that only 10% of the market was client activity, or only 10% of the clients rather were trading on CEF as recent as January, and I've heard 10, 15, 20, all about that sort of January, February timeframe. And again, so I guess the question being, what can we support by looking at the CEF data? So now we're turning over to CEF data in particular, like pure by individual CEF name, and looking first at credit. The chart in the top left, if you want to look at that's by individual CEF, and the bottom right is the more interesting as far as a dealer client assumption. Now, granted, we have open access, or it's certainly law that CEFs have to let everyone in. I'm pretty comfortable with the assumption still, probably for the small time longer that you can assume that the Bloombergs of the world are client CEFs, that the IDBs are dealers. So this is what I was referring to on one of the first slides, is that you can start to make assumptions with some of this data. And if you do assume that the client CEFs are client activity, the dealer CEFs are dealer activity, that you get this pretty good chart, right? You can pretty much see that there has been a very good uptrend in adoption of credit on CEF. Doing the same analysis for rates, and the picture is it's inverted as far as the percentage of what's being done by dealer and client, but the trend is still apparent by looking at down below. You can see that the blue bar is being how much was dealt on client CEF. So that equates to really about 4 or 5 time multiple increase in client CEF adoption. So I want to pass it on to the panel, but the just in summary, right? There's good adoption for credit. That's a very securitized market. I don't think anyone's too surprised to see that. NDF, it's showing some high on CEF rates, but it's a permitted trade at the moment. And interest rate, likewise, is showing an increase of buy side participation. However, when you look at what is off, we're noting that there's a vast amount of forward start trades, and quite frankly, that sort of magnitude of forward start swaps is just an attribute of the market at large. Is here and always has been part of the market. So with that,
thank you, Todd. Go to Wendy Yoon with Goldman Sachs Asset Management.
Thanks, Commissioner Amalia. First, I'd like to thank the Commission and the committee today for allowing us to participate in today's discussions regarding CEFs. This is obviously a very important topic for the buy side, not only because of how the rules have changed how we've historically traded swaps, but also the overarching impact on market structures, pricing, and liquidity generally. While we generally support the statutory principles of pre-trade price transparency and improving market efficiency, such as through trading of CEFs, we are concerned how these goals will be met given the compressed timelines for implementation and some of the regulatory uncertainties. From our perspective and speaking with many of our peers, we think that there are about 4 or 5 different high-level concerns or threshold issues about CEF trading. One is the CEF readiness. It is not enough for a CEF to be able just to list a product, but also it needs to consider whether or not it can actually support the needs of all of its market participants. And what I mean by that is, from the asset manager perspective, we need to make sure that there's a seamless integration to our order management systems so that we can get our trades into the systems in a very systematic and efficient manner. It is not a viable solution for us, and we don't believe a CEF is ready when they're asking our traders to manually input trade and allocation details of bunched orders throughout the day. That can cause additional latency as well as potentially heighten exposures to trade errors. Also, the CEFs have to take into account whether or not the dealer participants on their system can actually code to and support providing automated pricing for the products that they're offering. We found with some of the package products that have already taken effect that there were very limited dealers who were willing to provide pricing, not because they were not willing to, but because of the gateways and the interface that they had to the systems to provide such pricing had not been fully developed. The second issue that we are concerned with are costs associated with trading or participating in CEFs. Obviously, there's time and resources dedicated to negotiating rule books, to having to comply potentially with the oral and written record-keeping requirements of 1.35, as well as the technology build and infrastructure to support monitoring and the connectivity necessary to be able to effectuate the CEF trades. The third, I would say, is the need for global harmonization and regulatory certainty. Many of us are still, trading on behalf of global client portfolios. So we have different client bases. We would not want to be in a situation where we'd be forced to actually have to bifurcate our trades to multiple venues and to split up our trading practices for different types of clients based on their domicile and to access different pools of liquidity. It's also important, as we also have funds that may also be domiciled in Europe and subject to being financial counterparties and subject to the rules of EMIR for clearing and execution, but also based on their principal place of business are U.S. persons and therefore subject to the rules under Dodd-Frank. Fourth would be our concerns about general fragmentation of liquidity and market dislocations that may result as a result of the uncertainties that lie with respect to the global harmonization, some of the interpretive questions about the CEF rules and the implementation requirements. And we would urge that the CFTC consider all of these different concerns and how they are implementing the rules to date as it relates to CEF trading. Taken as a whole, all of these concerns can have a chilling effect of market participants from embracing the willingness to trade on CEFs. Thank you.
Thank you. Michael?
Thank you. My name is Michael O'Brien. I'm the Director of Global Trading at Eaton Vance. Eaton Vance is an asset manager based in Boston with about $300 billion in assets under management. As far as the question of why isn't there more buy-side participation on CEFs, I mean, I certainly agree with the 4 points that Wendy made, and also had a few additional ones. The building of CEFs wasn't for the buy-side. If you build it, they will come. It was, and it still is. If you build it and it's cost-effective and it's efficient to use, then they will come. We're in the business of investing our clients' money, and so we're looking for the most cost-effective way to implement our trades. And to the extent that CEFs fit that definition, that's where the buy-side participation will be. Now, I'm going to go into a few reasons why, at least from our perspective, why there hasn't been more buy-side activity on CEFs. But at least part of it is the buy-side doesn't adopt anything immediately. Nothing happens overnight. There's a lot of changes that need to be made internally that don't happen quickly. So I think to a large extent, a slow pickup in CEF trading, even in an ideal world, is to be expected. Just for a little history of what of how we've approached the CEF trading and the mandates. Before October 2nd, in many of the matted or now matted products, we were nearly 100% electronic execution. So interest rate swaps, to the extent we could do NDFs, even though they don't have a mat yet, and CDX, primarily we were trading those electronically. On October 2nd, once these rules came in and we became uncomfortable with the rule books and Rule 1.35 and a few other issues, we stopped trading electronically, basically because we could no longer trade on these CEFs, so everything went back to the phone. Now, our planned approach was, as the MAT came on February 18th, that we would be a participant on, say, 3 to 5 different CEFs. We would have everything ready to go. And in addition, and I think this is an important point, using an aggregator, which I'll get into detail in a minute. So our plan was, I can't connect to 17 CEFs. It's either 21, 24 that were mentioned, whatever the right number is. It's too expensive, both in terms of explicit costs as well as resources within the firm and the opportunity cost of those resources. So I had a guess of where I thought the right 3 to 5 to pick was, and using and introducing broker and an aggregator. I kind of use those terms interchangeably for this purpose. That would pick up the slack if I made the wrong decision, if I picked the wrong CEF, if liquidity wound up somewhere else. I would use that introducing broker model to allow me access to the market while I either decided to join those CEFs or move on. The current approach I have is that we haven't signed a single rulebook and have no plans to do so in the immediate future. What we are doing is using an introducing broker. And so all of the trades we've done to date have been through an introducing broker to keep us, at least we believe, out of compliance risks associated with the rule books. So the reason that we've gone these, there are really I think 4 reasons. The first one being the rule books. The issue with the rule books and signing them, I mean, one is it's a challenge to read the rule books and understand what they are and match the rule books we're most comfortable with where we think the liquidity is going to be in a given asset. The other challenge is this has never really been designed, on a buy-side firm, certainly internally for us. We don't have policies and procedures. We don't have the right approvals. We haven't had conversations with our clients to become a direct participant. In the equity market and in the futures market, especially, we're not direct participants. We use an introducing broker. That's the way our policies and procedures have been designed. It would be a very large undertaking to change all of that to become a direct participant on a CEF. It's not even clear exactly what we would have to do. We would just have to start a project to figure out what we wanted to do. Given the uncertainty associated with the rule books, with they're changing rapidly, we view certainly with all the conversations that we're having here on various topics, that there is regulatory uncertainty for us. Again, this is not our primary business line. We can't devote all of our resources to this, so we feel that the best way is to avoid the rule books for now and not become a direct participant on CEFs. The second issue is Rule 1.35. While we believe what we're doing is certainly in the spirit of 1.35, I don't know for certain, and I don't have. Again, I had to build out the resources and the procedures and make sure everything was in place to satisfy the requirements. I'm not able to do that right now until I have more certainty on what that rule means. So again, that would suggest move away from the CEFs and use the introducing broker model. And the third is costs. As I mentioned, both these things, it's very expensive to change these things. We don't know where the markets are going to be in a year or 2 years, or we're going to have to reinvest more money if something changes. So it's not an efficient use of our resources right now to delve into this. And the third is the alternatives available. And I think we saw that in some of the data that Todd presented. Especially in rates, there are a lot of alternatives, many of them CFTC regulated in the futures market, that can get us the exposure we need without trading on CEFs. When I go to trade on a CEF, I need to make sure that I have in place, I have the CEF and the clearinghouse and the introducing broker and perhaps a middleware, maybe a standby FCM, a final FCM. There are a lot of moving pieces. And it's also something I don't have a long history in dealing with. In the futures market, we have far fewer entities to face. We have established methods of trading. We're comfortable with the compliance and regulatory issues around these products, and they're a lot cheaper to trade. And so I think that it's very telling in the data. I think I wrote down that around 50% of rates trades, I think Todd mentioned, were on CEF, whereas 80 to 90% of credit. And I think a big part of that can be explained by there are more alternatives in the rates market to trade off CEF than there are in the credit market. And so for the variety of reasons we've mentioned, I don't think that where there are more alternatives, it would make sense that there would be equal trading on CEFs. The solutions for us in order to get more comfortable enough to participate directly on CEFs would be clarification of Rule 1.35, or perhaps even limiting how it impacts asset managers. And certainly encouraging the introducing broker model. I mean, that is something that most buy-side firms are using in the futures market, and I think also makes a lot of sense to use in the CEF market. And I think a lot of buy-side firms are starting to come to that realization. In terms of what to do next, the one thing I would say is there are a lot of issues that have been discussed throughout the day, including on this panel, on CEFs and what the future of CEFs should be. I don't think, and NDFs have come up, and I think it's very telling only 1% of that market has gone to CEF. I don't think NDFs are a very different market, and they're not the same as rates. They're not the same as credit. There are a lot of issues to work out. I would suggest that we shouldn't rush into moving CEFs into a world where, or moving NDFs into a world where they have a MAT until we resolve a lot of these issues and see some of this participation from the buy side pick up. Thank you.
Thank you very much. Our final witness for today, Mr. Fitzpatrick.
Thank you, Commissioner Amalia, again for the opportunity to represent the WMBA here. My name is Scott Fitzpatrick, current chairman of the Wholesale Market Brokers Association and executive director at Tradition. Tradition is one of the number of registered CEFs these days, as are my colleagues in the WMBA. We would historically, as you would recognise, as IDB CEFs. Sorry, I've been told to speak up. We've just heard from Wendy and Michael a perspective from the buy side in their uptake or their interest in executing onto CEFs. And if I'll probably just take a view from the other side of the fence, if you like, and up until February the 15th, I guess, which was a key date for CEFs, where that was in effect the first date where you had mandated execution on platforms that we've built. Michael made a great point, which is the build it and they shall come theory. We have, and if we're having a conversation specifically about buy-side interaction on their liquidity pools, they haven't. I think that really probably shouldn't be any surprise to anyone in this room, quite frankly. We entered the land of the CEF in October last year. There was a huge amount of uplift in terms of technology, infrastructure, corporate governance, capitalization, resourcing, just to get to the point from where you were not a CEF to the point where you were a CEF. Naturally, I think over the first few months of the introduction of CEFs, what you've seen is, both in terms of participation, people focus on their incumbent suppliers of services, familiarising themselves with rule books that they were introduced to around October time. I think it was a gentleman from Barclays at one of the TAC meetings who sat right about here with a stack of paper about 8 inches high, which represented at that time, I think, the 19 CEF rule books that they had to consider as an FCM for providing risk-based limits for client trading on CEFs. I think also, from our side, and we have, you can read our rule books on the various websites, but in terms of the infrastructure that we've now established and set up, we are fully capable now of operating on a number of access models, whether it's direct access as a participant on our CEF, or as Michael in the model that they've chosen to go with, which is not to actually become a member or a participant on the CEF, but in fact to come in through the introducing broker or sponsored access or agency access or any number of the variations of the description that kind of do the rounds these days, and everyone's got their own opinion on exactly what each of those mean. The establishment of that infrastructure, and let's just talk about onboarding for a second, because the theory that you can read a rule book, sign off on a rule book, fill in all the representations that you need to fill in to be a part of a CEF these days, whether you're an ECP or a MSP or a swap dealer, and be appropriately signed off and papered by the CEF that you want access to, doesn't by any stretch of the imagination mean that at that point you are ready to conduct active business on that CEF. From our side, we have infrastructure that has to be in place. We've got FCM relationships. There's an infrastructure requirement from, whether it's GSAM or Eaton Vance, between them and their IB. There's infrastructure between us and the IB. The IBs that Michael are talking about are choosing to act as effective aggregators of the CEF community. They'll take liquidity from various CEFs. They'll represent that to their clients, either in a truly aggregated model or just a pick and choose model. And then those clients, in theory, will be able to transact through those networks and execute directly onto the CEF behind the price. The infrastructure that has to exist between us in the CEF community and the IB at that point needs to be established. You then have the credit hubs and the FCMs. The FCM's got to get comfortable with putting risk-based limits on each of the platforms so that we can do our pre-trade credit checks prior to execution. We are in certification process with the likes of Triana and Market, but that infrastructure is not quite there from a push perspective into central limit order books. And then, the final point I would make is that there's a sense of, I don't know whether it's just because there are 10 or 15 or 20 CEFs to choose from in the market that people are going to naturally want to go to every one of those because there's liquidity that exists in every one of those CEFs. CEF liquidity pools are very, very different in nature. There's guys round the table, whether it's TradeWeb or whether it's a Bloomberg or whether it's Tradition or whether it's ICAP or whether it's Truex. Each of those CEFs represent very different styles of liquidity, very different representation by the dealers into those markets and by the participants on those markets. And there's an economic analysis that has to be done by the individuals that want to come into those liquidity pools as to whether they actually want to be there. And they have a right to choose. We make ourselves available and we have built it, and hopefully one day they will come because it's not been cheap. On that note, I will pass back to you, Commissioner, and look forward to the debate.
Thank you. I'd like to open it up for any questions or debate or concerns about any of this, and thoughts you may have. Mr. Oleski that runs a...
Thank you, Commissioner. Yeah, well, look, I think each of the panelists contributed very relevant information, and in our experience, the TradeWeb is somewhat of a unique animal in that we've got two different perspectives on CEF. We have one CEF that we call DW CEF, one CEF that we call TW CEF, and they each focus on different client segments. So the DW CEF is an anonymous order book that is largely interdealer in nature, where not knowing who your counterparty is irrelevant. It doesn't matter. TWCEF focuses on a disclosed model. And the reason I'm hitting these two differences is we're talking about a wide universe of clients that are participants in these markets. And I don't think it's surprising that it's taking this much time for people to adjust to this. Our own experience was over a year ago, we had much more volume than we did pre-February launch. So we actually were up here in e-volume, and as we got closer to the CEF date, we all took a significant dip in terms of activity as people were preparing for the live dates. What we've seen in the last few months, and even in the last few weeks, is a slow increase, a steady but significant increase, so that if I look at our volumes today, they're actually significantly higher than a year ago. So I think we're heading in the right direction, but this is a very complex ecosystem with a lot of technology issues. I think Wendy hit on a significant point, which is integration. I mean, it's easy to say we're going to build a CEF, but there's a lot that goes into connecting up the trader with just the matching engine that is the CEF. There's a lot of integration. There's credit checks, there's hitting risk systems, and you can't just have people willy-nilly sort of entering things in separately. So integration is a massive undertaking, which we've been spending a tremendous amount of time on for years and years, and we literally have hundreds of integrations with different customers. So, but each customer does not have the same amount of resources to apply to integration. They don't have the same amount of resources to apply to assessing rule books. So this is a continuum in the marketplace of the amount of effort and capital that firms can invest in adapting to this, and it's going to take time to see it through. But I think it's heading in the right direction. But look, we still have many rules that are being phased in the coming months. Whether it's the package trades that aren't complete until November, we still have another date coming up with switches in June, which should likely trigger more activity. So as we get through this process of adjusting to the rules and the rules become finalized across the board, I expect we'll continue to see, more and more volume. But I don't think it's any one thing. I think it's challenging as someone who's, running an electronic operation. You can become impatient with the speed with which things are working. But I think we have to be patient, and we have to get through these rules as quickly as possible in terms of their implementation.
Can you touch on kind of the status of the package trade? You mentioned that you're going to see volumes going up, but is that going as smoothly with the phasing as you had hoped? Maybe the buy side could also.
Well, I think Wendy mentioned this. It's package trades is not just a technology solution that needs to be delivered by the CEF. It needs to be delivered by the participants that are providing liquidity. So you have to be able to generate prices across multiple instruments very, very quickly. Now, that's not something that everybody has right away. So that's being phased in, and there's different capability among different firms. The other thing is there's still some significant packages that are not yet required to be traded on CEF. And that's happening in the coming weeks, I guess, and then months, 2 weeks.
Wendy?
I would add that on May 15th, we tried doing a mat-to-mat swap on a large CEF, and there was only one liquidity provider available on the system. So, those are some of the challenges that you are confronted with when the systems are not fully baked and people have not had a proper amount of time to actually build towards connectivity and providing liquidity.
Nick, do you have a...
Thanks, Scott. I wanted to share some statistics from our view. I think, as many of you know, we operate on behalf of the FCMs and a large number of buy-side firms as the pre-trade credit checking compliance tool. Agree with what Wendy and Michael have shared, and also similar experience, Todd, as you've shared in the data. Just north of 600 firms have been set up to trade on CEF in our utility. And those firms obviously manage thousands of funds. Most of those firms have 2 to 3 FCMs and are set up to trade on 2 or 3 CEFs. Less than 50% of those firms have executed a single trade on a CEF since the MAT dates. And of those that have, very few of them are trading regularly in CEF. So, at the end of the tail, we're set up ceremonial trade and gone back and looked to other markets because of all the technical issues on the end-to-end flow. And I think the package trade rollout is a good example where the industry was fairly transparent in the fact that the end-to-end flow from liquidity provision down through SDRs and CCPs did not yet support technically a robust process for handling packages. They've rolled out in advance of that, and the results are as testified to here. So I think the buy side are still very much getting used to new processes, but some of the new processes don't exist yet, especially when you get down to some of the more complex products.
Scott, if I don't know whether there's any representatives from FCMs in the room as well, but I think one of the things that certainly from my experience recently, one of the things that the industry is struggling with as well is the allocation and management of credit across potentially multiple CEFs all executing the same products, and not necessarily the distribution of the risk-based limits, but how the limits are consumed on individual CEFs, what happens to cancelled trades, error trade policies, and these are all things that factor into the allocation and distribution of liquidity across a number of CEFs. And obviously, firms like Triana will act as a sort of centralization point for a lot of that, but it's still, there's still a complex model there to be understood.
Yeah, just to continue on Nick's point, we sit in the middle of a number of these flows. We're in the pre-trade credit space, as Scott alluded to, as well as connecting up to SDRs and the CCPs. packages are one item that's coming down the pike. There's bunch, there's allocations, there's a lot of incremental features, workflow, systems changes. At least, we have definitely learned by being in this space for some time that really nothing happens in months. At best, it takes a year, and it usually takes a couple of years to get these things right. It's not surprising to us at all that there wasn't some sort of cliff event in terms of business moving. If people didn't have to, they wouldn't. And if people couldn't, they wouldn't. And they're looking to alternatives, whether it's alternative markets like the futures markets, maybe not permanently in their interim. I think that will be somewhat based on how quickly the industry can adjust. Hopefully it's not years away, but not. It certainly doesn't seem like months away. The packages are coming fast and furious between June and November. Our estimation, based on sitting in the middle of those flows, not just what we need to do, but what the CCPs need to do to adjust the SDRs. Ultimately, the world looks at trades as single trades that are strung together from a trading strategy, but not strung together operationally, either pre-trade or post-trade or anything in between. So we're acknowledging, at least from our perspective, that it is early in terms of the push to require it. It is a page from what I described before, which is push early and then be sympathetic to the problems when they occur, because they will occur. And that's at least a way to get there a bit sooner than if you waited for everybody to be completely ready for the flows, including platforms like ourselves that are not any of the SDRs, the CCPs, the CEFs themselves, but sit in the middle of a lot of those marketplaces and functionalities from a technology perspective. The other thing that will happen, the buy side, does talk about the fact that they don't have the resources, and it is a challenge. I think, the banks typically, who have been more flush historically, I'm not sure they are long resources either these days. The reality is there will be a lot of technology firms that come in and fill those voids. There already are out there. There are integration firms, there are connectivity providers. They're already out there. They tend to be focused in some of the OTC markets, but largely away. And we'll start to see some of those companies, provide services in the seams when any individual firm can't possibly do it on their own. But if one provider could provide the service to 10, 50, 100, or 1,000 entities, it starts to present some scale. But again, those just take time to develop. Business models are created on the back of that, and the solutions will be there. They just won't be there and feel very good in 2014 in our estimation. In 15, the light will start to come out, and by 16, it will start to normalize a bit.
I think from my perspective and in working with the division, one of the, what we've been focused on, recognizing we have this mandate in front of us with the made available to trade products that they're supposed to be required to be traded on the facility. But we've been looking at the fact that how the executions have been going. And that, for me, that has been a driver about determining the timelines where we've had some flexibility with respect to these packages that we know and we see that these CEFs are able to execute these transactions, and that operationally these things, the trading can happen and is happening on the facility. And so I don't want to pull away from that momentum, but being overly concerned about how other technologies that I know are in play will catch up. I know they're going to catch up because they need to catch up. So we're keeping an eye on the trading activity, and we're concerned that that activity occurs without incident, and as people are required to trade or organically will want to trade on these products, on these platforms, that'll decide sort of the success of this whole regulatory structure. And so that's at least my vantage point, and sort of picking these dates, looking at where can we get liquidity, where is the liquidity in this market. June 16, 15 is a big date, and I'm very focused on what happens on June 15, and I expect, just like on February 14 and just like on May, before May 1, I'm going to get some letters from very concerned market participants about whether and what we should be doing, and I'm going to be getting comfort from other market participants that says, stay the course. We need to work through this time, and we're working through this time, and I think in a very effective way.
Ed?
Hi, thanks, Scott. So my name is Ed Dasso. I work at NFA, and one of the services that we provide is outsourced trade practice market surveillance to both DCMs and CEFs. We currently have 17 of the 24 CEFs under contract, and I think the point that one of the things that we have the ability to do that maybe say the SDRs don't have is we track every execution by type. So what I mean by that is, we know when the transaction occurs in the cloud, when it's an electronic RFQ, when it's a voice RFQ, auction, any type of block, any type of execution method. And the trend I think that we've seen is obviously a gravitation more towards the central limit order book on the swap execution facilities that have liquidity. When we initially scaled this program, we had anticipated up to about 150 million messages a day, and we're not there yet. I would say back in October up through February, we probably saw almost a 2-to-1 ratio as far as executions to trade. So anywhere from, say, 4,000 trades a day to 8,000 total messages. Well, as of last week, we saw about 45 million messages across the CEFs that we have under contract. So there's healthy participation that we're starting to see, or gravitation towards a cloud. And Wendy had mentioned, the quoting in the different mat-to-mat strategies. That is definitely something that we've seen much more automation in the marketplace. Of course, there could be more. So I think the anticipation here is over the next couple months, we'll see more participants join the CEFs and start to auto quote, as well.
Couple questions and maybe a suggestion. The data that was presented by Claris, very interesting. I assume that within the commission you get similar regular updates. It sort of links back to the other topic about terabytes and megabytes and thousands of FTEs and whatnot. But if you don't, that's really scary. And I think that the NFA data that was just referred to, I think the commission would do a huge service if this was what one of the Harvard adages was: plagiarize, plagiarize, let no one's thoughts evade your eyes. It's also called cutting and pasting is much easier these days in an electronic venue. And I think disseminating the progress or the lack of progress in terms of uptake in these markets would do a big service in terms of demystifying and making people feel more comfortable or rightly identifying issues. So as I say, I won't ask you to answer my question as to whether if you're running a business and just had embarked on costing everybody billions of dollars, you would actually keep track of what the effect was. The other thing that I would ask about, which maybe the right people aren't here, because Kim is, your empire is large, but I don't think it includes Kim yet, is what the experience has been on the clearinghouse side. And I think from a risk management perspective, this is really kind of where the rubber really hits the road, which is to say, are the clearinghouses comfortable with what's going on? I know they're separate clearinghouses. Has there been, are they getting you've heard rumors about data and other issues in terms of trying to construct things. Are the CEFs really operating well with the various clearinghouses? As I say, maybe the right people aren't here, but I would hope you guys would really be keeping an eye on that, because that's where you would potentially be creating more problems than you're solving. And then the final observation, and the only place I've seen data on this is in the NDF world. And as you say, it's early and you can't tell quite what's going on. But it would appear that in the short term, one of the consequences of the partial introduction of the new regime is in CEF world, demonstrably larger bid offer spreads versus non-CEF world, and a shift of business offshore. Now, that I'm not up, real time on that. I last looked at this, visiting friends in New York, looking at screens where you can really see them side by side. And I would just, again, I think the ultimate test in this is not even volume as much as what the bid offer situation looks like in these markets. And are the markets, getting tighter? Maybe they're not tighter than they were previous to the changes, but is the delta at least positive since the introduction? And again, if they're not, you guys better be thinking about that. And I think, in fairness, that's part of the information that the market would find very interesting and reassuring, to understand what's going on in a more transparent way, because I don't think you're yet at a point, and maybe the market participants can talk about this, whether there's actually a visible clob next to the RFQ activity for market participants to understand exactly, what the opportunity cost is of their transaction. So questions, a little editorial comment there too.
Anybody want to comment on bid offer?
I mean, just very briefly, I mean, I think that plays to one of the points that I made earlier. When you're in a situation, whether you're Wendy or Michael, there are various styles of CEFs out there. There's your historical RFQ, disclosed models, right through the gamut to the pre-trade anonymous central limit order books. The difference being, and to talk about bid offer spreads, whether they're wider and or not, I don't get to see the bid offer spreads away from where we are, but ours is not too bad in our central limit order book, I think. But it's a variation in that model too, where you're faced with RFQ responses where you pick and choose whether you want to trade or not, versus whether you're looking at bid offer spread on a central limit order book, and it's up to you how you operate within that marketplace and how you choose to cross that bid offer spread, whether aggressively or you sit passively waiting to be hit. So I mean, there will be variations and differences, and they may be wider in some occasions depending on who the counterparty is, how big the trade is, and who they're going to talk to. But at the end of the day, I think, and I spoke earlier of the economic decisions that have to be made by participants as they go into the various CEF communities, is they've got to work out what trading style is right for them and what CEF is right for them and what kind of participant they want to be in those markets. And, as much as I'd like to think from the evolution of these markets that a lot of these guys will come to central limit order books, the reality is that a lot of them probably won't.
I just want to mention that, I want to see the central limit order books succeed. And I think part of the reason I'm not seeing the liquidity I would like or not seeing the tight bid offers I would like yet is because the buy side doesn't seem to be adopting it as quickly as I would have thought. I think in the long run, you will see in next year RFQ a central limit order book, or at least easily be able to observe that. And at that point, I think you'll see more buy side firms adopt the central limit order books, and banks will therefore have more of an incentive to provide liquidity there. But for a lot of buy-side firms that I talk to, they seem more comfortable with the RFQ model. My preference is to be on the order book, and all the trades I've done, all the MAT trades I've done through the introducing broker have all been on order books. And I think we'll get there, but it's going to, again, just like the pickup in volume for the buy side, it's going to take a while before we get to the point where the buy side's trading in the order book, and we have more liquidity providers there.
Can we sort of talk about data? So the question was, do we see these things in the data, right? So we haven't been looking at Part 43 because in theory, Part 45, the regulatory reports should give us all the information. We've been studying the data. We put out the weekly swaps report, which we sort of presented in the previous stack. The interesting thing we notice in the Part 45 regulatory reports is that we can't identify transactions that were executed on a CEF. And Marisol has left for the day, but that's a challenge we're facing. And so we are sort of talking to the SDRs, we're talking to the market participants. So it appears as if when the trades get reported, to us at least, whatever data, the reports we receive from the SDR, a critical field is not being populated. So we can't even see which transactions were done on a CEF. In terms of figuring out the quality of the market in terms of spreads and other things, we don't get message data from the CEFs. And even if we get message data, it's important to bear in mind a couple of sort of facts, right? And Todd should sort of confirm this. So a decent chunk of the activity is happening over voice execution. So, there is no electronic audit trail that even if we were to get the message data, it's not clear in what form it will come to us for us to be able to analyze the data. And then in the interest rate swap space, close to 50% of the transaction volume is for our switches. So the bulk risk mitigation stuff that happens. And they're not clearly price-forming trades, I understand. So I don't even know how to measure bid-ask spread for even what does it mean for 50% of the activity happening on CEFs. And the other, there are different execution methods that are being implemented by CEFs. And based on, this is just anecdotal information we have based on what the CEFs have shared with us, is decent chunk of volume, 60-70% of volume is happening through what they call the midpoint volume matches. So, which is not people putting bids and offers and the bids and offers matching. It's the firm coming up with a price and saying, here's a suggested price. Do people want to sort of trade at this price? So it's like a midpoint of the existing market. A lot like the way the crossing or the sort of the dark pools that operate in the equity markets. So there's a midpoint which is sort of published, and then people submit their trading interests, and trades are happening on the CEF. So if all the transactions are happening in the midpoint, a decent chunk, that means the spreads are really tight. So that's what we know about the marketplace. We don't have good data, or we don't have the data. And it's still sort of a market in evolution, and it uses execution methods which are very different from what we are used to seeing in the future space. So, we continue to sort of talk to market participants and understand it, but we are some ways away. The Commission, when we finalized the swap execution, the CEF final rules, the Commission has directed staff to complete a study of the swap market activity to make an assessment on how good the rules are, the impact of our execution method rules on market quality. So we have 4 years to sort of complete it, but it's not clear to me that we have the data. So we finalize the rules. Pardon? No, it's not even the size. It's just we don't have the data. And the rules were finalized on May 16th. I think the effective date was a month or two. So you talk about June 2020, and that's the deadline for us to finish it. And presumption is that we'll be working with DMO to do it. Question is, do we have the data to do it at that point in time? So hopefully we'll be there. But where we are today, this is the color we have, I guess, from where we are sitting.
I just wanted to add that I would say that the buy side would like to access liquidity on the central limit order books, but it's just a matter of time and the readiness to get there. I think right now there's a lot of competing priorities and goals that we're trying to achieve right now as it relates just solely to the RFQ platforms. There's questions about, pre-trade credit checks on block trades, on packages. We just learned today from one of the CEFs that now the CFTC may be asking that all block trades can only be treated as a block if all legs of a package trade exceed the block thresholds. That's something that was very new to many of us market participants to learn of that today. To have to build out to those systems, as well as to consider other types of competing priorities, such as, there are certain liquidity pools that are only available if you register with that particular CEF. So for NDFs, as a result of footnote 88, if you want to continue to access those pools, you also have to sign up, despite the fact that those products are not subject to clearing or MAT right now. So there's a whole host of issues that people are grappling with right now, which I think has kind of impeded the developments and market movement towards the central limit order books.
Just on the question or the comment about blocks. So for multi-leg transactions, for each transaction that has its own USI would need to satisfy the block level requirements set forth in the block rule. So we don't if you have a group of transactions and one satisfies its individual block, that's not sufficient to pull the other transactions out into the block. So that's right. What you heard today is accurate.
But would you be able to execute that one leg subject to the cap size limits and the real-time delays? Right.
You could execute it as a block, but you'd be subject to if it doesn't meet the notional value, you'd have to report it real time, and we can get the delay as if it was a block.
So a cleared lay that does exceed the thresholds, would that be permitted to be subject to the block delays and cap size limits? Or would the whole you're saying that the entire block has to now, the entire package trade has to meet the block size limits.
The entire package has to.
We've heard some questions about position limits on CEFs and how multiple CEFs may deal with position limits. Do you have any opinions on that?
Not for today.
Okay, one out of two ain't bad. Well, we heard policy being made right there with the block rule, so thank you very much for that.
Just on the block rule, just being consistent with what the block, what the regs already say with respect to blocks.
I'm sure it is. Hence the no confusion. Brian, and then Lee, and then I think we're done.
Just another kind of contributing, I think, issue or factor is, you know, we operate in a global organization in terms of what these markets represent, right? And so Wendy referred to it a little bit in her talking points in terms of not creating a bifurcation, a sense of liquidity, or creating situations where there may be uncertainty due to unresolved issues from a cross-border perspective. And so it's incumbent upon the CFTC and the foreign regulators to resolve a myriad of cross-border issues that are still creating a great deal of uncertainty, both for the operators as well as for the client base. We've always, you know, been very supportive of mutual recognition, and you know, the CFTC has taken, I think, a very proactive and flexible policy in that regard in terms of some of the actions that it's taken to date. However, we haven't, you know, received reciprocal treatment from the EU, and that creates very serious concerns, not only for the swaps business, but as well as the futures business. You know, we operate in both the U.S. and in Europe internationally. We have 10 hubs throughout the world, and it's incumbent upon the CFTC and the regulators to consider the broader implications in terms of these cross-border issues and the impacts that it may have on the overall efficiency of the ecosystem that exists today. We need to eliminate legal uncertainty that currently exists. We need to allow cross-border markets to continue operating without threatened disruption to both operations and efficiencies to those markets. We need to afford U.S.-based and foreign markets and market participants the same degree of flexibility today on an ongoing basis.
I'll be really quick. Two points. One is e-order books and rates. They're not there yet. So that's the real challenge. Most of that activity is voice, that's interdealer, and until there's meaningful e-order books, you won't be able to do these comparisons, and you won't have a meaningful liquidity pool for the buy side to tap into. I imagine that's going to come. We're not there yet. The second is the cross-border point. I think that Cliff started. The one place I would say, because we operate an MTF in Europe, so we have a very active swap business in Europe. And what we've seen with the phasing into the CEF rules is a definite shift in terms of currency. So there's much more dollar activity in the US and CEFs, and there's a lot less euro activity because the euro client base in Europe does not want to get entangled in CEFs, so they stay on MTF. That's something to watch out for, because I think without mutual recognition, we're scaring away a part of the client base that could be an active part of the liquidity pool within CEF, because they just don't want to be inside the CEF regime, and they choose to keep their marbles outside, which means there's less liquidity for U.S. counterparties in euro, sterling, yen, anything outside the U.S. That's a fact. That's happened.
Scott, can I just say one thing?
Oh, yeah.
I would like to agree with my colleague over there, Lee, that the QMTF regime, and there is still an opportunity to do the right thing there, and I think it would foster liquidity in US dollar markets overseas for US participants. However, I'd like to respectfully disagree with my learned colleague over there that e-order books and rates are there. We operate one. We've got tremendous depth of liquidity in our electronic interest rate order book. So I would argue that we are there in those markets. Lee and I can take that one offline.
He's wounded, so be careful. Well, let me thank everyone. This has been an extraordinarily helpful day, a very long day, of course. I'd like to thank all the new TAC members for joining, all our witnesses who have prepared for this and provided some very compelling testimony today to help us discuss this. Every panel was terrific, and I'm grateful for that, and I'm grateful for the time you've spent here. I think we're going to continue to focus on the surveillance tools this commission needs and the technology that we have at our disposal and how we integrate all the data. I think we're going to continue to follow the various data reporting elements with, I know SAI and DMO are struggling to make sense of our data, and thankfully we do also have organizations like TODS and ISDA and FIA that have all worked on providing new data to us to reflect on the market. Thanks to the CEFs who have been very forthcoming with their trading behavior. This is an issue that we will continue to follow as well. And a new issue you might want to think about in the future is this Bitcoin. There's been interest in this, and maybe we'll have to take that up at a future meeting. So thank you very much for your participation today.